To Anne-Marie Horton in Japan, and with her is Admiral John Kirby. He's National Security Council Coordinator for Strategic Communications. This for America at the G7 meetings.
Thanks, Tom, and that's right. He's on the ground less than 4 hours, and Admiral Kirby is joining Bloomberg First here as he lands with the president for this really important G7 summit. But of course, the president is scrapping the remainder of this foreign trip he was supposed to have, Papua New Guinea and Australia. How much do you think that domestic policy concerns are undermining the foreign policy goals of this administration?
It's not about undermining our foreign policy goals. I mean, the president has really revitalized. He's really put a lot of energy, particularly into this part of the world. I mean, here we are in Japan for the G7. You know, just a few weeks ago in San Diego, we were standing next to Prime Minister Albanese and Prime Minister Sunak to unveil the next phase of the AUKUS agreement. And of course, he's already had a chance to meet with all the Pacific Island leaders at the White House last year. We'll do another one here in the near future. So we have invested a lot of time and energy into this particular part of the world. And today's visit, this G7, I think, is just further proof of that.
But at the same time, the president loves to use these moments like a G7. He reminds the world America is back. He tries to draw parallels from democracy vis-a-vis autocracies, what's going on in terms of Beijing, what happens in Russia. How hard is it for him to deliver that message to other leaders when he was supposed to be the first U.S. president to go to Papua New Guinea? He was supposed to go meet the Quad in Australia. And this is where he wants to spend his time, like you said, in the Asia Pacific.
But the president knows, and so do these leaders of democratic nations, that if you don't take care of the nation's debt, if you allow the United States to default, virtually nothing else matters in terms of what you're trying to do around the world. You know, I heard comments, you know, by analysts that our credibility in the region is suffering because, you know, we're not going on 2 other stops. But the credibility really suffers if we end up, you know, being a debtor nation, if we default.
That was the message I got in Nagata from the foreign ministers. Will the president be able to...
If we become a deadbeat nation, then our international credibility and standing suffers. So the president is doing the right thing here. He's obviously, the G7 is important. A lot of things to discuss while we're here in Japan. We can reschedule a trip to Australia. We can reschedule a trip to Papua New Guinea. You know what you can't reschedule? You can't reschedule the looming debt ceiling deadline. That is a hard fixed thing, and we've got to make sure we get these negotiations through.
Critics will say then the president didn't manage this correctly. He should have been speaking to Speaker McCarthy earlier so he didn't have to cancel his foreign trip. But do you think the president here in the G7 will be able to say to leaders the U.S. will not default on its debt?
Well, the president's optimistic. He said that before we left. He said that he's optimistic that we'll get there. And so that's one of the reasons why we're going home a little bit early, so that he can be there to make sure that Congress does its job. But let's go back a little second on the talking to Speaker McCarthy. Not defaulting is a congressional duty. It's in the Constitution. There didn't need to be negotiations over the debt. Now, the president is willing to sit down and talk to Speaker McCarthy about the budget and appropriations, and we'll do that. But when it comes to raising the debt ceiling, that is something that has been done 78 times under Democratic and Republican administrations, without negotiations, without having to, you know, to have an argument about it. So there's no reason for, I mean, the argument that we should have talked, you know, X number of days ago. This is a congressional duty. They should just simply do their job.
This is something we're going to be closely watching here from the sidelines of the G7. When it comes to, of course, one of the biggest elephants in the room is going to be China. We know the U.S. wants to go after economic coercion that's coming out of China. Also, the Papua New Guinea trip was about deterring Beijing. Is there a concern from the White House that potentially, when it comes to, say, Papua New Guinea, that Beijing is trying to do a security agreement like they did with the Solomon Islands? How concerned is it about making sure that countries like that are on board with what the U.S. is doing?
Well, the trip in Papua New Guinea was not about deterring China. It was about, again, revitalizing, reinvigorating our vast network of alliances and partnerships in this region. A network, by the way, that China can't even close to match. Just can't get there. 5 of our 7 treaty alliances are in this part of the world, and a lot of people don't realize that. So there's a lot of network of partnerships and alliances here that we're trying to try to bolster. What we will still have discussions and some deliverables with Papua New Guinea. You'll see that, even though we're not making that stop, we'll see those move forward. I can't speak for what China's doing with each individual Pacific island nation. They have used a mix of intimidation and coercion, economic and security-wise, to try to have their way in this part of the world. We are not asking countries to choose between the United States and China. They get to decide what their bilateral relationships look like and who they associate with and what that association looks like. What we are doing is trying to show in demonstrable in ways that the United States is a reliable, stable, credible partner in this part of the world and around the world, and to give people alternatives to the coercion and the intimidation that the Chinese tend to demonstrate.
How close are G7 leaders aligned on this point on making sure they are de-risking from China? Most notably, I'm thinking of Europe and Emmanuel Macron after his visit, where he said that Europe actually has strategic autonomy when it comes to China.
China's going to be key on the agenda here in Japan, and I think you're going to see the G7 leaders all speak with one voice about the challenges that China poses here in the Indo-Pacific and around the world, but also what some of the opportunities are as the G7 nations are to compete fairly, but to compete well with China.
Besides broad strokes of words, though, will there be any action vis-a-vis China and the G7?
Well, I'm not going to get ahead of the discussions. The G7 leaders will absolutely spend quite a bit of time here, as you would expect they would, certainly here in Japan, talking about the challenges that the PRC represents. They will, I'm convinced of it, that you'll see at the end of those discussions that they'll all speak with one voice about how we need to treat that particular competition, not just from a security perspective, from an economic perspective, from a diplomatic perspective.
Admiral John Kirby, thank you so much for joining Bloomberg TV.
Good to be with you.
That was, of course, the National Security Council Strategic Communications Director, John Kirby. His first interview on the ground. He's been here for under 4 hours here in Hiroshima, Japan.
Spent most of that travelling from the airport, Tom, to an interview with Anne-Marie. AMH, great work as always. Looking forward to your coverage through the G7.
This is a huge, Johnny. He wants to go to what the debate is within the administration, and particularly within the Pentagon, which is a reaffirmation of America in the Pacific Rim. This was blown up. We had a joint blow up by 2 presidential candidates at the same time, Mr. Trump and Mrs. Clinton, former Secretary of State, who decided we can't do trade with the Pacific Rim. That was sort of the politics 8 years ago. Now we've got the establishment of 4 military bases in the Philippines, around to the west, the South China Sea, Papua New Guinea. How many people watching today know where it is on the map? It's 138 miles from Australia on the South Shore and goes up again, buttressed up against China in the South China Sea. What the Admiral is talking about there is a reaffirmation of naval presence within the Western Pacific, and that's the churning here beneath the headlines on
These
China.
are very serious issues which, funnily enough, feel like a distraction right now, given what's happening in America at the moment and the fact the president is abroad, when at home there are these negotiations ongoing about the debt ceiling. What was the phrase that Kirby used then? We don't want to be a deadbeat nation.
Yeah,
and
well,
not meet our
that's
obligations.
percolating in the zeitgeist.
Pretty strong stuff, TK. Just to reset things for you, if you are just tuning in, your equity market slightly positive on the S&P 500, up by 0.26% on the S&P. Yields in the bond market shaping up as follows on a 10-year by 3 basis points higher. 360, let's call it, on a 10-year at the moment. I think we can just about call it that. 359 on a 2-year, Tom. 417, close to 4.17% on a 2-year this morning.
Killing me right now, folks. Bramo, it's killing me is well understood. I can never buy any financial securities. That's part of my agreement with Bloomberg. And it's killing me right now on the double we're seeing in some of these regional bank stocks. To provide medication, Gerard Cassidy joins us right now with RBC Capital Markets. Gerard, one of your colleagues in crime, Chris Marinac over at Janney Montgomery Scott, basically has a double price target on these banks. Is that too optimistic? Do you actually have a double price target on some of these selected regional banks?
Tom, we do, and I'm in your camp. I'm not permitted to buy any financial stocks either, and it kills you, especially with the preferreds, with the yields that they're offering. But the stocks came down to such low levels as a result of, as we know, the March Madness, the disruption in the market, the turmoil that was created by those three bank failures. And I think it was overdone. And you saw yesterday in particular, many of the stocks were up 5, 6, even 10%. And I think you can see in some cases a double with selected names because it was way overdone to the downside in our view.
Is it all clear on this Thursday morning?
The short answer is yes. All clear. I would just refine that to say all clear on a deposit flight. For the problems we saw in March, it's an all clear. Now, the banks always have challenges like any industry. And so if we go into an economic recession in the next 3 to 6 months, even though yesterday's Atlanta advanced real GDP number came in at 2.9% for this quarter, which is a surprise to the upside. So if we have a slowdown or a recession, there will be challenges for the banks. But based on the problems we just came through, I would say it's an all clear.
What does all clear mean, Gerard? Does it basically mean we're not going to get a financial crisis akin to 2008, or does it mean something deeper in terms of not necessarily an acceleration in the number of insolvencies in this region?
Lisa, I would say it's the latter point, because when you think about what was going on during March and the deposit challenges during the week of March, what was it, 10th or 11th, it was quite frightening for a number of investors, and they sold their bank stocks because of that. We just don't see that happening because those three bank failures were idiosyncratic. They were very unusual, those business models versus regular banks, and we just don't see that type of failure or that type of problem going forward.
We're going to get a slew of Fed speak today where they're going to assess the economic scenario. And Steve Matthews of Bloomberg put out a story saying that next month's meeting, we are likely to get an upward revision to growth by these Federal Reserve officials. How much of that is fueled by this idea that these regional banks, once thought as cooperators in trying to bring down inflation and slow the credit impulse, maybe won't be such cooperators and will continue to expand loans and continue their function much more than people previously expected?
You said it well, to continue their function, because banks are in the business to lend. And if you're, they weight the risks of lending versus the quality of the applicant. And as you saw in the senior loan officer survey, which we chatted about a week ago or so, that the demand for commercial and commercial real estate loans is down quite a bit. So if this economy starts to show signs of maybe better strength and the demand starts to come back, the banks will definitely be lending. In fact, Lisa, the real risk, I think, to the banks is that they cannot get inflation under control. And we have a Fed funds rate a year from now that's close to 7%. That would be a problem for the banks.
What about the regulatory overhang? I mean, we're going to be hearing from Fed Vice Chair of Supervision today, Michael Barr. We're also going to be hearing from the FDIC chair. How much are you hearing this willingness to regulate further after perhaps this was, I don't want to say idiosyncratic, but maybe contained?
I think you will definitely see regulatory change as a result of what happened in March. We anticipate that there will be negotiations obviously going on with the large banks and the regulators to make sure that it's not a knee-jerk reaction to what happened. And I do expect it will take some time, as Vice Chair Barr has pointed out. We expect that they'll probably put a policy out there for debate by the end of the year, probably put it into implementation by the second half of next year, and it goes live probably in 2025. And I think it will be manageable. We just got to make sure it's not a knee-jerk reaction to what happened in March.
Not that I can take advantage, but Mr. Cassidy, your single best buy this morning to take advantage of this silliness?
I would say, Tom, that in the regional space, we would have to go with Fifth Third. As you know, they're based out of Cincinnati. And what's interesting about this story is that it's a very well-managed bank under the leadership of Tim Spence. But more importantly, longer term, you're all very familiar with onshoring and what's going on. And the state of Ohio is really at the center of that. So that's a long-term economic driver for Fifth Third, as well as KeyCorp and Huntington, which are all based in Ohio.
And what an interesting call to leave it on. Gerard, thank you. Gerard Cassidy of RBC Capital Markets. Connected to this conversation, is it the next shoe to drop? Commercial real estate. Prices falling in the first quarter for the first time in more than a decade. This data brought to you by Moody's Analytics. A less than 1% decline, but notable nevertheless, led by drops in multifamily residences and office buildings. The chief economist, Mark Zandi, over at Moody's Analytics, saying this: lots more price declines are coming, TK. Now, this was a concern picked up by the Federal Reserve as well in their semi-annual financial stability report. Yep. The vice chair for supervision at the Federal Reserve, Mr. Michael Barr, has talked about this as well. This is a major focus, TK, for you and for so many other people too.
Major focus, and John, I got a lot of humility here in that I'm really an amateur on it. My only solution is to read every single article I can, sometimes skimming them, of what was in 4 or 5 years ago and what the exit valuation is. And I think the operative number is more than a third haircut. Is what, if it's a bond, you're at 100 and you're moving out at 70 or 8 or 60 or 50. And it's property after property, even away from the ones we know are traumatized. That's what's important.
The size of the decline this morning, Lisa, that we're talking about is not notable. It's the decline itself. We just haven't had one for so long.
Which is notable. Just basically, this is an area that hasn't been stress tested, right? And this is the concern. What else is under the hood? But I have to say, if you take a look at the valuations in the secondary market, it's been substantial, 15 to 20% types of declines in commercial real estate. So, how much is already priced in and anticipated by a lot of investors? This is really the issue with this market. It's not like these looming threats are unknown to people or unprepared for. And this is the reason why it's not going to necessarily be the boogeyman that people are expecting.
Well, they're certainly known. How well prepared for them we are might be a subtle difference there, Tom.
Yeah, again, my amateur take is to take SPG, Simon Property Group, which I'm told is like first class, world, best in class, off a last decade high, down 52%. And that's, I'm told, the Bentley of it all. I read Cranes. Cranes is doing a great job. Bloomberg's real estate people are doing.
What's that like? What's Cranes like?
Property to property, I'd say, John, it's a really important question. They're doing a great job. Not every day. Every 3 days, there's a transaction, maybe a small building in Brooklyn. It may be something in Cincinnati we were just talking about with Gerard. And it just walks you through one given real estate transaction. And some are like, they were 100 million and they're selling them for 70 million, and some are a lot worse than that.
You want to talk about residential just quickly?
Yeah, this is not this is commercial.
You mentioned Brooklyn, residential. Rents in Brooklyn.
You're on a tear here.
Just going through these numbers this morning.
Are we?
No. A median 3,500 in Brooklyn now, up almost 15%. That's rent in Brooklyn. Median 3,500.
We did this on the break. It's take the rent, gross it up 1 year rent, and it's about a third of your income is like rational. That's $154,000 a year you got to have in Manhattan.
How much is that you just can't buy? Right? I mean, how much is it basically people are priced out of buying, or they don't want to take out a mortgage at this kind of rate, so they are going into renting, and then that's pushing up the rents because you've got people who otherwise would be buying going into that market. And how much is this creating kind of a vicious circle right now?
This goes right back to the conversation we had through this week, work from home. Because if you've got to go into the office and live close to Manhattan, that's what you're paying.
How about work from South Dakota? I mean, you get to a point where everybody exits.
Totally. We'll continue this conversation. And some news on Deutsche Bank. They're not screaming, get back to the office. They're screaming, let's cut the office space. We'll come to that later. This is Bloomberg.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, you know, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
The Bears are unhappy. The Bulls are unhappy. Everybody's sort of universally unhappy.
Right now, folks are pricing that this is going to be a very tumultuous debt ceiling.
It feels like there needs to be another round of drama before they come to resolution.
We still look for the market to panic a bit more.
I would still put a hike in June or July at kind of the 30 to 40% range.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market not doing much this morning, waiting for numbers from Walmart. Those numbers will drop any moment from now, Tom, as we put together earnings for retail this week from Target, from Home Depot, and Walmart any moment now.
Most optimistic Thursday you and I have had in ages. I mean, we've got Max Kettner on earlier from HSBC, and we're bouncing off what Stephen Cohen said, the owner of the Mets, and of course all his work at Point 72. We're going to advance that forward, John, and it's percolating here. What do you think? Debt ceiling? What do you think? Earnings? Was it Target?
Debt ceiling optimism, whatever that is. I mean, what is that?
I don't.
What's debt ceiling optimism?
I like what Admiral Kirby said, where he said we've done it 78 times or whatever, and it's just like, okay, raise the debt ceiling, let's move on. And we can't get there in this political moment.
Let's move on right now. We get some numbers from Walmart, including their full year projections for EPS. So let's start there. For the full year, adjusted EPS, a range of 610 to 620. The previous range was 590 to 605. The estimate was 614. The stock is higher in the pre-market by 1.9%. Lisa, what else have you got?
Basically, total U.S. Comp sales ex-gas up 7.3% versus an estimate of 5.8%. You could see across the board beating, and the fact that full-year adjusted EPS is coming in so far above expectations. Second quarter adjusted EPS $1.63 to $1.68. They had seen $1.70, so that's slightly below, but they expect the rest of the year to pick up. Basically, this is confirming the view that perhaps there is more strength in the consumer consumer. Perhaps there is more strength in the economy, and it goes to this question of perhaps taking off the tail risks and having a soft landing be more of a base case for a growing number of people.
And I'm going to go, Lisa, where you were on a 6.7 same-store sales, which is a nominal GDP equivalent. We heard from Barclays earlier in the hour that nominal GDP may stay elevated, and whether you believe in nominal or real, whatever that analysis is, it's the wind behind you. I'm doing the sailboat. Can you see me in a sailboat?
Nice, that works. Can't see you on a sailboat. Can see you as a passenger on a sailboat. Can't see you working on a sailboat.
I get so seasick, I get on and I lay down. Okay, wherever point A to point B, I'm laying down on a 3-island tour.
I can see that working. Yeah. Certainly not
USS Dramamine.
The rest of it. I don't see you jumping from side to side doing things with the sails. I wouldn't know what to do with the sails either, but I just
come about hardly.
Whatever that is.
Tom, go downstairs, sleep.
I'd do the same.
Have a Narragansett.
Walmart in the pre-market higher by a little more than 2%, raising the outlook. Let's whip through the price section for you. Elsewhere in the equity market on the S&P 500, equity's a bit firmer by, let's call it 0.25% on the S&P. Yields a bit higher by 3 basis points on a 10-year, 359.44, and just to round things out at the front end, higher every single day this week. Monday, Tuesday, Wednesday, Thursday. Yields approaching 420 again, Tom, at the front end. 417 TK on a 2-year in America, up another couple of basis points this morning.
I'm watching standard deviations there. We're not up to breakouts. We mentioned this in the last hour. Is it breakout Thursday? Will it be breakout Friday over the weekend into Monday? But we're really buttressed right up against it. I don't know where it is on a 2-year. I'm going to guess 424.
We found a bull. She joins us around the table. Barbara Reinhardt, the head of asset allocation at Voya Investment Management. Barbara, good morning.
Good morning.
You're bullish. Why?
Well, look, we think there are a couple of things that are likely to go right. Inflation is still going in the right direction. Yields are very supportive, but have come off of their highs. That gives the PE multiple for the S&P 500 a little bit of wind at its back. But mostly, we think that it's going to be the economic data is slowing enough that the Fed is able to take their foot off of the brakes and maybe take a break or a pause in their hiking cycle. And that is a very good tailwind for the equity market.
At this point, you've been perhaps painfully long the U.S. over the rest of the world, and this has been sort of a contrarian trade as everyone piled into Europe and the rest of the world. That's starting to shift around the margins, at least this week. What gives you confidence that it has staying power and that you'll basically be able to say, I was right all along, it just took a little bit?
We never say that, Lisa. But nonetheless, look, we think that the U.S. has some really good qualities to it, right? So the Federal Reserve was one of the first central banks to start raising interest rates. Inflation in the U.S. peaked a number of months ago. It's on the right trajectory and going in the right direction, if not fast enough for all market participants. But in Europe, think about this. A lot of bad news had been in the price in the fourth quarter of last year. A lot of things didn't happen. So not necessarily incrementally good news, but the disaster scenario didn't happen. You need things to go in the right direction for Europe to continue to work. A lot of fund managers are indeed putting assets out there. We're seeing asset allocators start to put money overseas. That's generally when the data has to really start breaking your way. If you think the U.S. has an inflation problem, Europe has a much bigger one and a much stickier one, and their central bank is much further behind the curve than the U.S. is. So at the margin, we think that the U.S. is likely to outpace the rest of the world.
The U.S. outpace, let's be blunt, more than anyone we talk to, Voya is America first. How does a dollar fold into that? I mean, to me, the big surprise here, no one is looking for a resilient or strong dollar. John, DXY, a 103 level, BBDXY, 1236, all of a sudden resilient dollar. Is that part of the America first story?
Well, look, you don't necessarily need the currency going in your direction in order for the U.S. to do well. I think part of it also is the visibility that you have on the U.S. is actually quite good. The U.S. consumer is holding in there quite well, even in the face of job openings coming down and some rebalancing in the labor market. So the U.S. just has more strength to it, and we think that's at the margin a relatively good thing.
So you're in a meeting with retail or high net worth individuals with Voya, and they go, we own 85% of our portfolio is Apple. What else do we do? I mean, come on, we all own Apple.
I know.
It's an outrage. What do we do after Apple?
Well, the good news is when you saw some relatively good news on the debt ceiling yesterday, you saw some of those other parts of the market that haven't done relatively well start to pick up. So mid caps, small caps, even real estate investment trust yesterday did a bit better.
Exxon is a mid cap, in case you're taking notes, John. John.
But I would say the thing is, if you can see some broadening of the leadership, that is a relatively good thing. But you've had narrow leadership across the entire globe, right? So what's been doing well over the past 5 months has been U.S. tech and European luxury goods, right? So seeing a broadening out of the strength of the market is a good sign.
Just to be clear, do you expect that to continue, that broadening out?
We would certainly hope so. The inflation data in the U.S. we think is likely to go our way. And we also see that potentially getting through this debt ceiling problem is good. I would note, if the U.S. economy tends to be too strong, or if the inflation data starts to break higher, that goes right in the face of how we're positioned in our portfolios. But we think, at least for the next couple of months, things are going to go our way.
Just to be super, super clear and specific here, we know the most crowded trades, at least indicated by the Bank of America Fund Manager Survey, are long tech, short banks.
Right.
Are you leaning in the other direction then?
Look, I think you've got to be a real brave person to buy the banks at this point. But remember, we're top-down global, so I'm not making sector decisions. Okay. I'm positioning more in terms of countries and in terms of style tilts. So, but we think that the U.S. is probably the strongest place to be. I mean, you know, at this point, thinking about the rest of the world, the only other place that I would probably really think about allocating to might be parts of Japan, because it looks like it's so cheap and it has a big benefit to it from the currency at this point. But for us, the U.S. is probably the place to be.
Just to tie this conversation back to what we were speaking about with Max Kettner of HSBC earlier, he was saying it's not really a sector kind of market. It's an everything on or everything off kind of market. This is why asset allocators are tearing their hair out right now. Are you finding that it's the same thing, but it's country specific, everything on in one country or one region, everything off in that region?
Yeah, I think it's more regional probably than specific countries, right? These markets can be very thin. When you have narrow leadership, you have to be on the right side of pretty much everything. It's very difficult to go into risk on and risk off positions. You have to really pick where you see the best visibility, and the best visibility for our part is in the U.S.
Right now, is big tech sort of a necessary play within that basically you have to kind of ride the big tech wave, and that's basically what's going to distinguish the U.S. from the rest of the world?
Well, we think that big tech actually did a couple of things right also. Remember, last year, all of the layoff headlines were in big tech firms, right? So big tech took a very big view in terms of trying to right-size some of their cost measurements for the difficult investment environment that specifically that segment of the market was feeling last year. So they took some of their medicine early, and then of course they have the benefit of this whole AI big boom that's going on right now. So look, could tech take a breather? Absolutely. But I would say that probably the best part of it is the dynamics for them are probably a bit stronger than the rest of it because they took their medicine last year.
I'm looking at a small cap, United Health Group, and everybody keeps talking medicine, medical, health, whatever the sector categories are. Is that part of an American play?
Look, small caps have really been beaten down. Post-SVB, small caps have really taken it on the chin. You probably need to get some of these recession fears off of the table in order to go very long small caps.
What about medical across small, mid, and large cap as well?
Again, I can't talk to sectors. We don't invest that way in our funds.
How'd she get on set? You can't talk sectors?
I can't. We invest more so in terms of top-down global macro. Look, I do think that I can't talk United. I can talk healthcare, I can talk utilities, I can talk technology.
I don't want you to talk United, but talk to me about medicine, healthcare. Yeah. We're all getting older. Is this angle going to work?
Well, look at the...
Lisa's not, but you know.
Look at the cover of the Financial Times. It was all of this morning about, that you have to right-size pensions, public pensions, because you have an aging population. If it's not healthcare, I don't know where it is.
There we go. I think that answered your question.
It took like 4 questions to get it out of her.
Sorry.
I don't know.
Barbara, you're great.
Give her a tiny mimosa. We'll get
Barbara
you
Reinhardt
tough
there.
crowd this morning.
Of Voya Investment Management. Bullish this market. US over the rest of the world. There you go. Just pushing back against some of the consensus out there at the moment, which has been pretty gloomy. Tom, LVMH, the luxury players in Europe, up like 30% this year. Apple, up something like 30% this year. To Barbara's point, that's where the gains have been.
I don't understand it, because how many people out there can do luxury? And the answer is it's hugely aspirational. And I guess the entry point's there. People they're going to do it. That's what they're going to buy.
Oh, yeah. And LVMH are going to keep buying everyone else.
Well, yeah,
and that's
that as well.
Been happening for years.
Well, it was also the big China play. Remember, luxury has been a big way to play China reopening without having to go and buy the emerging markets.
In a big way. in a big way, particularly for that company. LVMH, Lisa, are up by 29%, Prada up by 31%, Kering up 15%, Hermes up 37% year to date. Pretty phenomenal.
Have we already baked in the China reopening trade? That's the key question for the second half.
Based on the data so far
Yeah, exactly.
that we're getting from China, feels that way. Jim Bianco's got a lot to say of Bianco Research. He joins us in about 50 minutes' time. Looking forward to that conversation from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and other group of 7 leaders have begun arriving in Japan for their summit. China and Russia will be the top problems on their agenda starting on Friday. Now, Russian President Vladimir Putin continues his war in Ukraine, and a post-pandemic China is busily expanding its economic and strategic clout. Meanwhile, China's President Xi Jinping is holding his own summit. The 2-day China Central Asia Summit will assemble the leaders of Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, and Uzbekistan. Now, it's Xi's way of reminding the G7 of China's influence outside the U.S. world order. There's growing speculation that Ron DeSantis is about to announce that he's challenging Donald Trump for the Republican presidential nomination. The Florida governor is summoning financial backers for a meeting in Miami next week. While they're there, the donors expect to make fundraising calls on behalf of DeSantis. Micron is set to land about $1.5 billion in financial incentives from Japan's government. That will help the company make next-generation memory chips there. Micron will install advanced chip-making equipment at its facility in Hiroshima. Japan has been trying to increase production of semiconductors. In the UK, BT Group plans to cut its workforce by up to 42% by the end of the decade. That's when the country's largest network operator completes its nationwide fiber optic rollout. BT says the number of employees and contractors will fall from 130,000 now to as few as 75,000. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The president knows, and so do these leaders of democratic nations, that if you don't take care of the nation's debt, if you allow the United States to default, virtually nothing else matters in terms of what you're trying to do around the world.
That was John Kirby of the National Security Council catching up with Bloomberg's Anne-Marie over the G7 in Japan. Forget the happy talk, the mood music, the optics, the tone, let's talk about the numbers. The Treasury's cash balance, $94.6 billion as of May 16th, according to data published just yesterday. That's up from the day before, but compares with $140 billion at the end of last week. So that's come down a fair amount, Tom, in the last week or so, and that's what we're watching, the cash balance going into early June.
Coming down and moving quicker. Greg Villiers has a number this morning of 87 billion, down from that 90x billion number. I don't know how many billion they need, to get the coffee poured in the Pentagon and other things that they do in government, but the adults are telling us 87 billion is borderline. Keep the government open.
Everyone's saying the same thing. We won't default. President Biden said, I'm confident that we'll get an agreement on the budget. America won't default. Jamie Dimon, the bank CEOs, met with the Senate Majority Leader Chuck Schumer on the debt limit. This was the quote from him. The U.S. should not and probably will not default. Whatever it is, we'll be prepared. Lisa, that hardly fills you with confidence, does it? The U.S. should not and probably will not default. I'd hope so.
Secretary Dimon?
I mean, the fact that we're even having this discussion and normalizing it is ridiculous. I mean, just going to put some sort of clarification on there, sort of sense of the feeling that you have broadly within the business community as well as beyond. But here's a question. Yes, get past the can-kicking exercise, but then what are the consequences in terms of funding mechanisms, in terms of reduced fiscal response? These are some of the questions that people are trying to parse out.
Emery Horton with us right now. She's our Bloomberg G7 correspondent in Hiroshima, Japan. Lots to talk to her about on debt and on running out of money in Washington. Emery, I want to touch quickly here on your discussion with Admiral Kirby. I don't want to go into a history lesson right now, but the bottom line is this is our last World War II president. He attends the Pacific Rim, and all of this is a backdrop of a failed TPP 8 years ago, whatever it was, years ago. What is the Biden Pacific strategy before we talk about the Biden debt and deficit strategy?
Well, I think today they're almost linked, right? Because part of the strategy of this foreign trip was not just to be here in Hiroshima at the G7, but it was also to go to Papua New Guinea. This is a country that the U.S. is courting, but also that Beijing is courting. Yeah. And then it was also to go to Australia to meet with the Quad. So he had to cancel this because of the domestic issues back home. And that is because he wants to be home by Sunday to make sure that next week he can be there to get this over the finish line. So I do actually see these stories together, but over a bird's eye view of what the United States is trying to do in the Asia Pacific is really this, what they would now call de-risking, not decoupling. That's the new word du jour for the G7 leaders, de-risking from China and making sure they are building these alliances in the Asia Pacific. Right. They're going to talk about economic coercion when it comes to China. Is it just language? Are they going to actually put details to it? They'll likely point to this deal they just did with Micron in Japan. But this is part of what the U.S. is trying to do. But they want to do it in a multilateral form. And what I think is really interesting at this meeting is to see how the Europeans play with the United States when it comes to Beijing.
When the president gets home, and there's always that drama of, the glamour of the G7 and hanging out with Emery Horton and all that, and they get back to boring Washington, they come off the plane, and they have to de-risk with, in this case, the Republicans. How will the president of the United States, with all of his legislative experience, de-risk with Speaker McCarthy?
Well, I think he's trying to do it now by cutting his trip short and making sure he's getting home. Because right now what McCarthy is doing is almost winning when it comes to the public opinion. What you see out there saying, why is the president traveling? Why didn't the president meet with me sooner? Then he wouldn't have had to cancel this trip. They want to make sure that they can get this done before June 1st. Admiral Kirby there saying that obviously foreign leaders do not want to see a default in the United States. Obviously, that would undermine the entire global financial system. So the president really has aides around him here, updating him what's going back in Washington, and then he's going to have to go home and seal the deal. But of course, negotiations are happening. The negotiations have narrowed, but we still don't have a firm deal that we're going to see past Congress at this moment. So there's a lot of work that still needs to be done on the debt negotiations.
Anne-Marie, we're getting some contours of what that deal might look like, and work requirements are looming large over everything. Can you give us a sense of what the Democratic pushback is and where this is?
So the president spoke about this before he left for the G7, and he seemed to be really against work requirements when it comes to access to health care and health insurance, but didn't talk about others, like potentially groceries. So there may be wiggle room when it comes to work requirements outside of the medical space. That is one area we're watching. The other thing, of course, is Republicans are really digging in their heels when it comes to unspent COVID funds, when it comes to energy permitting. So there's going to be a lot that the Republicans are really trying to get the Democrats to cave in on, because at the moment, the only bill that has passed one part of Congress in the House is Speaker McCarthy's bill, and that does raise the debt ceiling, but it comes with measures that Democrats say are just draconian.
We've been talking all morning about how the mood music has improved. Has the mood music among the people who actually know what the negotiations are like improved? I mean, do they really sense that there has been a shift, or is this basically just happy talk from the leaders to try to play to their political base?
Well, I think it's important when leaders come out and they say we will not default. That does mean that they want to get to this finish line. I think one thing that a number of individuals, and you hear from individuals in Congress talk about, that not just Democrats are taking notice, but the White House is taking notice, that Speaker McCarthy, everyone was pointing to as someone who was not going to be able to hold his party together, to hold the entire 218, his conference together, because of the 15 rounds of votes he needed to become Speaker. And I think a lot of people are looking at him and saying he's been able to hold his conference together, and he has a great deal of leverage in these negotiations, which is why I think they are feeling very tough at the moment. But the fact of the matter is the negotiations have narrowed. The president cut his trip short, so the White House is determined at this point, as you can see, to get a deal done.
There is that hope. It's out there. Anne-Marie, thank you. And can I just say again, just wonderful coverage out there, just to kick off things at the G7 in Japan with Anne-Marie Hordern going into the weekend. The president will return. There will be some hopes out there still that we have a framework for some kind of agreement laid out by the staff level talks that will continue into the weekend. We'll keep building on this. But ultimately, Lisa, you want to hear some real fundamental progress instead of just things are going to be okay, we're not going to default, which is kind of mood music type stuff, to your point.
Yes, correct, which is the reason why people haven't totally taken it off the table, because they know how things go in Washington. It feels good until it doesn't. But at the same time, there's then what next? What do we worry about after that? Is it possibly how we fund this? Is it possibly, China, U.S.? I mean, this is sort of the issues that people are looking for right now, and not getting the all clear kind of signal.
I look at where we are, and I'm going to go back to fundamental macro and our star, John Williams, Tom Laubach, and the rest. And the answer is, John, this whole shell game is based off a reduced R-star, and there's a raging debate in economics about, do we continue forward with a low interest rate, low Fed rate regime that can keep this debt and deficit shell game going, or is it a whole new world after all? We've got things to worry about. Nobody knows.
Well, we found the buying point in the regional banking system, haven't we?
Oh,
interest
yeah.
rates.
Rate of change on interest rates.
Have we found it in the U.S. economy?
It's a really important question, and I think a lot of people would say is move from a nominal analysis to a real analysis. And when inflation comes down, let's say you get a David Rosenberg at Hyman disinflation, nominal GDP comes down, and that's like in Buffett's language, the water moving out to see who's wearing swim trunks. And the answer is, it's going to be interesting to see as we have disinflation which way that ambiguity cuts. We don't know.
Let's talk about Walmart. Walmart's doing well. Is that a good thing for this economy? Walmart's up by 1.5%
you're
in the pre-market.
Dump on Bentonville, Arkansas this morning?
We're going to build on some of their numbers.
We should do a remote there, the three of us.
Question.
A lift to their outlook. The average ticket is up. Transactions are higher. They seem to be taking business from elsewhere, Lisa. Walmart's doing well.
It's a good question that you ask. Is this good for the economy, or does this mean that people are downshifting from whole paycheck, as Tom likes to call it, to Walmart? And that's really the issue that people keep talking about.
Remote down there, we could get members of the Walton family on to,
that would be cool.
Talk up the future of Walmart.
We should do that, yeah.
We should do that.
Whole paycheck is getting so expensive. It's like 2 paychecks now.
Now it's like
it's
rent
nuts.
in New York City.
It's like, yeah,
it's
close.
like another rent. There you
Rent
go.
in New York City, eh?
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities just about positive on the S&P 500. You don't want to know what we were talking about in a commercial break. Deadly stuff. Deadly. Cereal.
I just top-ticked
Cereal in the morning.
John, I went to Whole Foods and paid more than I've ever paid before. I mean, that's that inflation thing going. And I'm not buying stuff Lisa's buying.
It's ridiculous.
Grandma's buying gluten this and gluten
nuts how
that.
expensive things are.
Yeah, well, I would agree. But the problem is that, you are saying this, to eat healthy is so much more expensive. And it's a huge issue because how do you feed a family in a healthy manner if you are constrained on the paycheck front?
You sit down for a box of cereal, which I just believe is cattle feed for humans. It's just terrible.
Did you ever see the Jerry Seinfeld Saturday Night Live? Where he basically said that
I know Seinfeld.
he was doing like nightly news, where he basically was saying like,
but I appreciate the clarification.
Something is coming up. It's going to kill you. It's in your household. We'll tell you after the break.
Cereal. Let's get to the bond market. This won't kill you. 2-year, 10-year, 30-year.
But no one to do that.
Who knows? Yields are higher by a couple of basis points, up on Monday, Tuesday, Wednesday, up again this morning, going into claims about an hour from now. 418 on a 2-year. On a 10-year yield, we're higher by 3 basis points, up to about 360. I've just got this image now. Someone's sitting down for cereal right now, watching this, and they're just like, screw you, Pharaoh.
Throwing the cereal at the screen.
Enjoy your Cheerios, all right? In the FX market, we look like this. Euro, just a touch weaker, just holding on to 108. I find this really interesting.
I agree.
This slow grind.
Strongly agree.
This slow grind, just chipping away at this short dollar story, Tom. 108.11 on the euro against the dollar.
A 107 handle to the FX pros out there. How distant is that from 105 where we start a parity chat again? I'm not saying we're going to do that, but all of a sudden 107 handles, not a 110.
Things change, and then 106, and the data's going in that direction, Lisa, and I think that's what's interesting about this. Not all at once, and I've said that a few times this morning, but just slowly, just chipping away at it.
And how much does this completely upend a lot of the bets that were the most popular the first half of the year? Taking a look at some of the stocks, the reason why we were talking about cereal is because of Walmart, believe it or not. The fact that it had better than expected earnings and those shares up almost 2%. This had to do in part with their grocery business. In other words, how much are people going there rather than Whole Foods, Whole Paycheck, whatever you want to call it, because of how expensive things are getting? Again, is this good news or bad news for the U.S. economy, John? You've been asking that, but we have seen upside beats in so many of the retailers. Cisco, a very different story. Those shares significantly lower, at one point down significantly more than this, now 3.7%, retracing some of that. They said that there was a sharp decline in orders in the past quarters that offset a positive sales forecast, people looking at demand and not really seeing it there. That's a separate story. Western Alliance, now this is interesting, and I know I'll get eviscerated for quoting the percent change. It's up almost 4%. It's nothing based on how much it's fluctuated around.
You're okay. No one's going to say a thing.
That's not true. But anyway, moving forward, yesterday, this builds on the rally we saw yesterday. Regional bank stocks had their strongest rally in 2 years yesterday. And all it took was Western Alliance coming out and saying, yeah, we got some deposits. And everyone's like, yay, it's over. And that seems to be where we are this morning as well.
Relief rally, squeeze, call it whatever you want. Just got this from a terminal subscriber, won't name them. They said this: if cattle feed had marshmallows, the cattle would be happier.
I like
marshmallows in your cereal.
I grew up with that, and I've got to say, if you eat Lucky Charms, you have to eat the oats first, so you let the marshmallows sit in the milk to get soft, because they're kind of cardboard when they come out, and then they're good.
I like the nutrition things. I actually look at them, and I just did this, John, for Walmart to add on to Lisa's important report. Fruit Loops. Have you ever had Fruit Loops, John?
Sure.
$4.98 a box. I'm sure that's a Walmart price. 24% of your daily sugars. Oh. In a 12-ounce, an itty-bitty,
but low on fat, yay. That's the thing that does my head in.
24%.
You said it's the sugar lobby.
You start, but what's important here is Ian Lincoln gets up in the morning and slams the Fruit Loops down at 4 a.m. before he writes the bond note, and he's 24% to his daily sugars right there. What do you do with your beverage of your choice late at night?
Orange
that gets
juice.
Up to 140%.
Orange juice. You want orange juice and Fruit Loops.
Why don't you bring
Good for you.
I love this.
Good for you.
He's worried about having too much sugar intake in the morning for the beverage of the choice in the evening to save it for that. All right.
I'm saving it for the beverage of my choice. John, bring in our colleague here on the healthcare show.
This is what Ian's got to say from BMO, not on healthcare, on the Federal Reserve. Incoming Fed speak is consistent with a committee contemplating a pause in June. We're expecting the next 4 weeks will settle this debate in favor of no hike and thereby allow the cyclical steepening of the curve to commence. TK, this is an interesting take because they're contemplating this pause, not committed to one, and they're actually going some way, making the effort, I think, to remain open to the idea that they might hike again at the same time, which has been interesting this week to witness that.
Red on Global Wall Street, Mr. Lincoln joins us now with BMO Capital Markets. Let's take it over to a bond guess from the Econobabble, which is if you get a pause in the Econobabble, is it asymmetric, means they're going to cut, or is it truly symmetric? And how does a bond market react to a symmetric view of a pause?
Well, to your point, Tom, I think a symmetric view of a pause is precisely what the Fed is trying to communicate at this point. Up until this stage, everyone believed that once you hit a pause, that it was terminal, the next logical move would be a rate cut. We can see that that's still priced into the bond market even at this point. We have 58 basis points of cuts by the end of the year. That suggests that the market does not believe in the market does believe in the asymmetry, doesn't believe that a pause is just a pause.
President Mester had this to say this week, that she does not believe it's equally probable that the next move is a cut or a hike, leaning into the idea that the next move could well be a hike. Do you not share that view?
I don't think that we will see a hike. I think the Fed actually is at terminal. What I'm very sympathetic to is the Fed's looking at the futures market and saying, we want to remain on hold well into 2024, and to avoid a market disruption between now and the end of the year, let's convince the market there is a little symmetry around terminal.
What's on your dashboard right now, just in terms of the economic data that suggest, give you evidence, just a couple of signs that we are at terminal, and this is the right place to be? This is sufficiently restrictive, to use the Federal Reserve's phrase.
I think the one piece of data that we're looking at that is very convincing is core services CPI ex OER and rent. Now, the Fed has told us to look at that measure as ex shelter, but that includes the hotel component. So the real core services number is actually at just 0.1.
So a bunch of words there. Can you explain to all of us what that actually means? What are you tracking there?
So within there, all we've done is we've looked at what real inflation looks like, excluding what it costs to live in a home. And I think that that's how the Fed has told us to view the forward trajectory of realized inflation.
Where's Walmart on that dashboard of yours?
So I do think the earlier observation that was made regarding the rotation out of higher-end retailers into Walmart is a typical into-the-cycle transition that certainly resonates when we think about the fact that real wages have failed to keep up with inflation. The fact of the matter is, real purchasing power has declined over the course of the last 24 months.
But if we have, Lisa, if inflation comes down, are we going to lower wages? That's never happened. We're not Britain. The answer is wages are going to stay up, and all of a sudden real wages are pretty good if inflation comes down.
Well, it's the pace of wage increases as well, and whether they can continue to go up at the same level. And this is something that people will be parsing through. But to build on what you were talking about with respect to the consumer and the resilience and sort of the downshifting, the gradual downshifting, what we've heard this morning, whether it's Barclays, what we're going to hear from Ellen Zentner of Morgan Stanley, is this idea of a soft landing, and that it's becoming more and more likely as we do get a slow grind lower, not a sudden fissure. Are you in that camp? Are you growing sort of accustomed to a this time is different kind of feel?
Well, I think it's useful to add the context that hard landings and soft landings look the same in the beginning. And it's not until you actually hit an inflection point that people look back and say, oh, actually, that was a hard landing. And the inflection that we're looking for comes in the form of the jobs market. The Fed has told us that they're expecting that the unemployment rate will end 2023 at 4.6%. If we look historically, that's very unlikely to happen because anytime the unemployment rate is more than 0.3% off the cycle low, it spikes by 300 basis points, not by 75. And so that means that once that inflection hits, we're going to see companies snowballing, saying, okay, my competitor is laying people off, I'm going to do the same, I'm not getting punished in the equity market to do that, and that's where we end up at a 5.5 unemployment rate, and that's something that's going to get the Fed to move.
I got to make some money this morning. I need to buy some Fruit Loops at Walmart. They're crispy loops with fruity flavors.
Nice.
Thank you. And to do that, I've got to make a duration call. What's your duration call now? Do you extend duration? Where's the most efficacious play in the curve?
So at this moment, we're very interested in 5s, 30s re-steepening. Now, we got above 40 basis points. We're now back below 27. A move to 50 or 55 basis points.
We'll buy a lot of Fruit Loops.
We'll buy a lot of Fruit Loops.
Okay, I just want to be sure of that.
What is it about the 5-year piece of the curve that you like versus, say, playing it through the 2-year and further out? What is it about the 5-year?
So a 5-year gets us through the current cycle. It gets us through a period where the Fed emphasizes retaining terminal for an extended period of time, and the market is content to look at what happens when the Fed, even if it is a soft landing, still needs to cut rates in 2024 and 2025. And embedded in that is the idea that the Fed will be successful in bringing down forward inflation expectations. And even from a technical perspective, the 5-year sector at 360 starts to look pretty cheap.
Implied by that call also is this idea that maybe we go back to low neutral rates, right? Isn't that your call too?
Yeah, I think that, as you said, implied by our kind of forward forecast in this environment is the assumption that if inflation is structurally higher, it's only structurally higher for a specific period of time, and as long as the Fed's committed to that 2% inflation target, they're going to bring us back to a lower rate environment going forward.
Interesting call. Ian, thank you. Ian Lincoln there of BMO Capital Markets. Thanks for being with us. TK, some fascinating stuff there. There's so much embedded in that call, 5-year, 30-year steeper. When you really start to think about it, there's a lot of assumptions baked into that.
And this is what Bramo did for years with Bloomberg leading the bond coverage. I mean, it's not just the 2s10 spread. There's a lot of information in different spreads. Right now, I'm focused on the T-bill spread, T-note spread, the 3-month 10-year. But, you know, a guy like Lincoln, I mean, he's got 6 of them tattooed on his left arm.
Well, T-bills right now.
He's got 10s, 30s, and
as Lisa
5s,
knows,
30s. And
T-bills right now are a mess, aren't they? Particularly over the next month or so.
So they've been the ones that have been most reacting to the potential for some sort of debt ceiling debacle, and that's come off just a touch. But then what happens after that if they issue more T-bills in response to some of the funding mechanisms? I mean, there are a lot of vagaries here as well after that hurdle gets leaped over.
Have we finished the healthcare segment? Are we done? I think we're done.
I had no idea.
We're never done.
Fruit Loops has red 40 in it and yellow 5, I think it is.
What is
and
that?
Blue. It's food coloring.
Nice.
My sister lived on Fruit Loops for like 4 years. That was like that was her major
like bouncing
food
off
group.
the walls.
You know.
I'm sure. Joe Feldman's going to join us shortly of Towsey on Walmart and the retail sector. That's coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Walmart is raising its annual profit forecast after posting better than expected earnings in the first quarter. Comparable sales easily beat Wall Street estimates. Still, Walmart expects shoppers to remain under pressure this year. President Biden is in Japan for a Group of 7 summit on Friday in Hiroshima. Leaders have a number of challenges ahead of them, including how to enlist nations outside of the group, as many countries have resisted sanctions on Russia due to the pressures on their own economies. There's also the question of how to handle China with its perceived economic coercion. Meanwhile, China has kicked off a European tour aimed at brokering peace in the war between Russia and Ukraine. A top Chinese diplomat met with Ukraine's President Volodymyr Zelensky this week. Li Hui told Zelensky that ending the war would require all parties to build up trust. Ukraine has said it won't accept proposals that include the loss of territory. President Biden hopes to be re-elected next year by defending his victories in 2020 battleground states. But he also wants to expand the map into states like North Carolina and Florida. In a memo obtained by Bloomberg News, campaign manager Julie Chavez Rodriguez argued that Democrats strengthened their hand with their performance in midterm races and in this year's special elections. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Companies are passing on costs, as is sort of legitimate to their customers, but then they're using that as sort of a cover story to convince their customers to also accept a profit margin expansion. In certain sectors, and again, it's not everywhere, but in certain sectors they've been enabled to expand their margins, but we are starting to see the consumer fight back.
One of the best communicators in economics, Paul Donovan there, Chief Economist at UBS Global Wealth Management, has a different point of view on a range of things, but TK always dresses it up so nicely with different stories. I just enjoy listening to him every single time he comes on the show.
I think it's a legacy of George Magnus. UBS did this. They had Jonathan Anderson in China, who owned the high ground on the study of China away from the easy-to-study Pacific Rim shore. And the heritage of the Union Bank of Switzerland was wrapped around John Anderson, George Magnus, and this young kid, Donovan, who now is the eminence grisee there and really doing smart 15-page essays. And you read them.
And George transitioned to becoming like the guy on China
I've
which
read
I
his
thought was
book.
very
I
cool
read his
over
last
the
book,
few
cover
years.
to cover. And these guys, I mean, this is
What was
the
that? Red
heritage.
Flags?
Yeah, it's brilliant. I couldn't remember that. And folks, this is really important. All these firms have a different character, including Telsey Advisory Group. And the answer is they have character and they have a style. And Paul Donovan's representing that now at UBS.
Well, before we get to Telsey, let's get to Walmart and talk about retail just briefly. The stock is up in the pre-market by 1.5%. They've raised their outlook for the full year. A bit softer than anticipated for the second quarter, but we saw a little bit of that yesterday from Target as well. But then they committed really to the full year outlook. A lift for Walmart. Walmart 152, let's call it, Lisa, in the pre-market, up by 1.6%.
And this is really a theme that we keep seeing. There is resilience and there is an ability to pass along price increases far beyond what the input prices show. So Walmart, yes, perhaps people are trading down, but there's also an underlying strength fueling potentially future sales.
Well, that phrase is important, Tom. How much of this is just trading down from elsewhere, taking business from other retailers?
I like what Ian said there. It happens all the time. It's the theory. You know, things get tough, and for a lot of America, it's tough right now. Let's not forget that. And people trade down. To give us perspective here, working with Dana Telsey always, it's Joseph Feldman, just really quite good. Terse reports. What did you do? I mean, let's get out front of your research. I need to front run you and Dana this morning. Do you change your view on Walmart with this optimism we're getting in the last hour?
I don't think so. I think you want to stick with Walmart here, especially in the environment we're in at the moment. And, you know, we're hearing from so many of the retailers that there's a lot more concern about the second quarter, concern about the economy, what it's going to look like in the second half. And in tougher times, Walmart tends to shine.
Dana was legendary at Bergdorf Goodman as a kid. She was like 12 years old, and if somebody was caught shoplifting, they had to babysit Dana, you know, for years. Joe Feldman on shrink, on the theft we saw with Target yesterday. Is there shrink at Walmart?
Yeah, there's absolutely shrink happening at Walmart. They haven't called it out quite the same way Target has, but you know, all the retailers are dealing with the shrink issue, the theft, organized crime. It's a big deal, and I think it's a big part of the equation for a lot of the retailers. It's a big number, maybe less as a percentage of the overall total sales for Walmart, but the dollar amount might be as high or if not higher, I would think, at a Walmart relative to Target. And it's not just these two. Again, this is across retail, and the retailers really need to work with local authorities to find ways to try to stop this, because the current way to do it is you have to lock down a lot of product in the stores, and it makes it for not the great shopping experience for the consumer. It really feels uncomfortable for those that are not there for theft. They just want to buy stuff.
Putting that aside and giving the fact that this is going to be a policy consideration going forward, there is a question about what period we're in. You said these times that we're in. What times are we in? Are they at one of strength with the consumer having spending power or not?
So it's been very confusing. We're getting lots of mixed signals. We believe the consumer is a bit stronger than most, you know, otherwise believe. The reason I say that is you're seeing spending on consumables, household essentials, basic items. People are keeping, you know, their food on the table and keeping the house running. At the same time, you're continuing to see increases in sales at dining out, entertainment, going to sporting events, travel. All of those, you know, service-oriented economy is still actually doing fairly well. I do think we're going to see spending slow a bit, broadly speaking, but those pockets of the economy right now would sort of indicate that the consumer still has some money to spend. Now, I agree, they're not spending on discretionary goods, and we don't expect that to pick up much this year. I think you're going to see more of the same, and then you could start to parse it out by income level, where the higher income people are the ones that are really spending on the services. The low to middle income, they're the ones just focused on getting food on the table, keeping the household afloat.
In Walmart's earnings, it's kind of a microcosm of the broader story on a lot of fronts. You've got people who are downshifting perhaps to grocery, and grocery certainly does account for a significant amount of volume, but the profit really comes from the other areas, and you can see that the margin is expanding there like it is at other companies as well. In other words, the input prices that they experience, they can pass that along and then some, and consumers will keep buying and buying more than expected. How long can this last, that they actually just can increase their profit margins and just expect the consumer will eat the price increase?
I think what we're seeing, a lot of the profit margin increase from Walmart and some of the others, it actually relates to greater efficiencies and getting better leverage. And if you look at comparisons from a year ago, supply chain costs were through the roof. Those have come down pretty significantly. So that is providing some cushion. I think, as far as food and consumables and basics go, Walmart especially passes things through pretty quickly. So as prices have been moderating, which we're hearing inflation is starting to moderate on that side, they're passing that through.
Joe, CFA 101, you got a single-digit nominal GDP grower. They're bringing pennies down to the bottom line. And I'm enjoying a forward view on Walmart of a 24 multiple. You got to be kidding me. How do you, really, with great respect, how do you and Dana adapt to a 24 multiple on the biggest aircraft carrier in the water going through the water at 4 knots?
Well, it's a big aircraft carrier that's becoming sleeker. They're doing more with higher margin businesses, advertising, online. They're transforming. They're kind of meeting in the middle with Amazon. If you think about it, think about the valuation that Amazon trades at. Walmart has gotten a lot more efficient with their online business. They've grown that. They have a marketplace very much like Amazon, which is highly profitable. They've got more third-party sellers coming on. So there's a lot that Walmart's doing to kind of borrow from the Amazon playbook that would argue that they are becoming a more dominant and more important retailer, building their ecosystem in more profitable ways, and therefore require, or would warrant, maybe not require, but warrant a higher valuation.
Interesting. Joe, we've got to leave it there. Thank you, sir. Joe Feldman there at Towsey Advisory Group on Walmart. Their stock is up by 1.8% after raising their outlook. The average ticket increased, transactions higher, raised their outlook. Everything okay on that front this morning. This is Citi's Andrew Hollenhorst, just publishing again this morning. Had this to say. Keeps building on this theme at the moment. The hike probability is rising as Q2 real GDP growth looks increasingly likely to come in stronger than Q1. I don't know how many of you saw this yesterday. I know a lot of people wrote into me to talk about it, but the Atlanta Fed GDP forecast, do you know what it is now? Just shy of 3%, 2.9% so far.
I don't think this is a small matter, and it goes back to the legacy of this show is we've been hearing people talk recession for 18 months, am I wrong? 18 months, and we're going to get double back-to-back 2%, 6 months of 2% growth. That wasn't modeled in.
Well, but the problem is that the response function to that, we don't have clarity on, right? We don't know how much this ends up in the sort of tail risk of a resurgence in inflation that then causes even higher rates. People have been whipsawed all over the place, and that's what we heard from Barbara Reinhardt of Voya Investments. She came out, she said, that would be against our positioning right now because we're not anticipating that. Nobody was just a month ago. It creates a real pain trade.
Let's see what claims bring in 35 minutes. Then on to Chairman Powell on Friday, Tom.
June 2nd, Jobs Day.
Yeah.
And what are they going to do to Hollenhorst? The idea of rationalizing a quarter-point increase. What are you going to do with an unemployment rate 3.4%? Where do they model it? They don't have enough information how to model it. I get it, but we're miles from 3.8, 4.1%. We're miles from that.
There is a belief they pause in June still. That was the belief in the immediate aftermath of the news conference with Chairman Powell only 4 weeks ago or whatever it was. We had that conversation on this program that morning, Tom. But Tom, you asked the right question that morning. What kind of data would it take to reintroduce the prospect of a real move in June? Alicia Levine was great yesterday on this program from BNY Mellon. It feels like they're sort of pretending that they're open to going again in June, but ultimately, what if it is live? What if it is? What kind of job number would you need in early June, Tom?
That'll be it.
Jim Bianco of Bianco Research joining us next. I believe he's in New York. Very cool.
Really?
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open
for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Certain sectors, you're getting an expansion of profit margin, which has led to the inflation that we've had over the last few months.
The message from earnings season is that there's still inflation in the system.
Yes, inflation's come down. Has it come down nearly as quickly as the central bankers would like to see? No.
Once the Fed stops easing, then we'll see the strength return. It's really pretty well balanced.
We got this chill, cool duck hanging out on the surface, furiously paddling underneath, and that's the equity volatility bid.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Amy Wu Silverman there, paddling the duck, and the duck this morning is a duck of optimism, John. Optimism in the air. That's the message.
An optimistic duck, is that what you want to say?
It is.
That might be the message, but the market so far over the last month has been a bumpy road to absolutely nowhere. We've talked about these numbers a few times, that on Tuesday we had the biggest one-day loss since May 4th, and then Wednesday we had the biggest one-day gain since May 5th, and here we are in the S&P still struggling to break out of a range. For the economic data, front and centre, about 29 minutes from now, we're going to look at jobless claims. 264 is the previous number. 251 is the estimate in our survey. Let's see if that comes back down. Certainly a theme over the last couple of days, pushing out the recession call. Enda Curran, Reed Pickett, here at Bloomberg, did a wonderful job, Tom, of really outlining the story at the moment, which was recession, and then kind of like let's push that out a little bit further.
And also, there's this gloom about what's going to happen. The world's going to come to an end. I think there's a consensus view that earnings for the first quarter, we're wrapping up retail now, and Walmart, Lisa, you mentioned, I'm sorry, Walmart is the right phrase, better than good?
It's better than expected, and they've got an upgrade to their forecast, but it's not just Walmart. It's Bed Bath & Beyond, which has been left for dead. They came out also.
Quite literally.
Literally left for dead. I mean, they were supposed to go bankrupt and then get sold off and liquidated. They beat expectations and upgraded their forecast. It's everyone. So at what point are we looking at not perhaps, as we were talking about yesterday, the lag effects of the Fed hiking cycle, but the lag effects of the stimulus that was injected into the system during the pandemic?
What did we get out of Ian Lingan? John, summarize from Ian Lingan. I mean, the guy's world famous, acclaimed and all that.
Well, what I heard from him, Tom, to put it simply, is that he shares the idea of the IMF, which is that rates go back to pre-pandemic levels. And that's embedded in his call that he thinks you get a steeper 5-year, 30-year. He wants to take out the effort of the Fed right now, which is why he wants to start with the 5-year and look for 5-year, 30-year steeper, because he thinks ultimately over that time horizon, 5 years out, rates are going to go back to where they were before.
Lisa, this is a hugely important theme in that the Bloomberg Total Return Index, the aggregate index, negative 17%. We've never seen it in our lifetime, no question about that. And the adults like Lingan aren't looking at 3-month paper, the kinks because of the debt ceiling or that. They ever having the courage to look out and bet on duration, which means price up, yield down.
You asked a really good question earlier, Tom, which is, have we found the terminal rate? Have we found what the new R-star is, where we've got this sort of optimal Fed funds rate? And we don't know, right? And this is really the big question mark, because we don't know if this economy is responding or slowing enough to a 5% Fed funds rate. What does that tell you about where that neutral rate really should be?
26 minutes away from claims. Is McKee with us today, or is he in transit somewhere?
McKee's with us.
He's with us?
Yeah.
Very good.
New York
Two-year yield, John, 4.18%, up from 3.85%. 2 cups of Sanka.
Getting closer to 420. Yields higher every single day this week. I'm going to skip the market check and get straight to Jim Bianco, president, founder of Bianco Research in New York. Love this, Jim. Good to see you.
Good to see you in person.
Are we mistaking inflation for retail sales? Your question, are we?
I think we are. If you look at retail sales and you look at the gains, because we look at it nominally, and if you take out inflation, we haven't done anything with retail sales in 2 years right now. We've been trending sideways. So when you see the 0.4 of a gain in April, remember that we also had 0.4 of a gain in inflation. So it was just really the price increase. And we're saying that was the increase in retail sales. But net, there was no new units being purchased. I might add that if you look at things like UPS and stuff, they're telling you unit sales are kind of been stagnant as well, too.
So when you look at the temperature, or rather take the temperature of the U.S. economy right now, what do you find?
I think we're back to where we were pre-Silicon Valley, because pre-Silicon Valley, when Chairman Powell spoke, he talked about a strong economy. We were talking about 6% inflation. 6% funds rate, because the economy was, remember the phrase no landing? We were back to no landing again. Yeah. And so we're kind of back to that mentality, but we still have this overhang coming, and that is, what about this bank walk? What about the turmoil in the banking system? What about when we get the debt ceiling resolved and $1 trillion of treasury bills are going to be issued that's going to suck reserves out of the system? Does that drag the economy down later this year? But not now. Right now, it has this feel of early March again.
In my chart of the week, without question, is what John was talking about. You've got our retail sales going up, Walmart good, and the rest of it, the luxury that John talks about. And the actual inflation-adjusted retail sales are flat. But corporations think in the nominal space. Are you saying lighten up on the stock market?
No, I think what I was trying to say with the chart is that when people look at retail sales and they want to gauge the health of the consumer, on a unit basis or on an after-inflation basis, they're not making any ground. They're buying the same things for the same price.
Yeah, but to our listeners and viewers, it says Jim Bianco says lighten up on stocks. Are you saying that?
I'm not necessarily saying that. I'm kind of, aggressively neutral on stocks right now. I think that they're going to trend sideways. My bigger theme
my third divorce lawyer said that. Continue, Lisa.
I was going to say my bigger theme on the stock market is I think we're going back to something like the 80s and 90s. We're going to go back to like a stock-picking, rotational type of growth market. It isn't so much, is the S&P going to go up? It's which sectors and which stocks are going to perform.
What does aggressively neutral mean? Seriously.
It means what you see the chart over the last year. If you look at a chart of the S&P over the last year, it's gone sideways. It's the same place it was in May of last year, last fall, and it's in January. It's at the same point that it was. And we just kind of meander sideways. It doesn't go up. It doesn't go down. Even yesterday's big rally took us to the highest levels we've seen in a week. And so we don't go anywhere. There's really no trend. That's what aggressively neutral means.
Does this account for recession, or is that basically increasingly not off the table, but looking less likely?
I don't think it's looking less likely. I think it's not evident now. Ask me in the fourth quarter, where are we with the banking situation? If the bank walk, let me define that. People are saying, I'm going to take my money out of a 1 basis point yielding Chase account, and I'm going to put it into a 4.8% yielding Chase money market fund. And if hundreds of billions or another $1 trillion comes out of the banking system little by little by the fourth quarter, we could have a real credit crunch on our hands, and then we could be talking about a significant slowdown in the economy. We don't have that here in May. What we have is something that looks more like March. And I think a lot of people are trying to dismiss what's been happening with the banking situation and thinking it's not a big problem. I'm not there yet. I still think there's still chapters to be written in that story.
You've said that a few times about being back at early March. 2 years about, let's call it 90 basis points south of where we were in early March. As you indicated, Chairman Powell was opening the door to 50 basis point hikes, and we were talking about 6% Fed funds.
Right.
So how are you thinking about Fed funds now and the path for the Federal Reserve, given what you've just said?
Let me throw in another nuance on it. I think that inflation is going to bottom for the year within the next 60 days because there's a gigantic base effect coming with the inflation numbers. Last year, May was 0.9. Last year, June on inflation was 1.2. When we take those numbers out and replace them with about a 0.4, which is what we've been averaging, we should be in the low threes on the inflation numbers by July when we get the June number, and that should be the low of the year, and it should start drifting higher. So I think what Chairman Powell is going to look at is he's done. He is basically higher for longer. He's at 5%, and nothing short of a full-blown recession, I think, is going to get him to cut rates.
Do you think then we're going to slowly chip away at what's priced in this market, or do we do that all at once? How do you foresee that gets priced back out?
I think we're going to slowly chip away. I think we're going to find that the majority of job creation in this country is companies of less than 500 employees. Those companies do rely on small and medium banks. If those small and medium banks are impaired in any way to give them financial services or loans, that is going to be the chipping away at what we're going to see with the economy as it slows. And they're going to be impaired because their deposit base, they're unsure about it. It leaves, it's going to money market funds. They're not quite sure what their lending capacity will be or the profitability.
This is what Oxford Economics had to say as well. They agreed with you, and they said that they think that the banking turmoil begins perhaps a prolonged downturn akin to what we saw with the S&L crisis in the 1980s. Does that bring inflation by itself down to the ultra-low rates that we saw pre-pandemic? Do you agree with Ian Lingen's view?
No, Ian's a friend, and I'm going to diverge from him a little bit. I think we're in a new, I use my fancy word, post-pandemic economy, which means that we are in a higher inflation environment than we were pre-pandemic. We're in a 3, maybe 4% inflation environment, not a 6 or 8% inflation environment. And as we go forward, we're going to learn this is a very different economy than it was, say, 2019. And it has more frictions and it has more pricing problems than we've seen before. Now, eventually we'll restructure the economy and wring that inflation out, but that's going to take several years.
Jim, you're going to be with us for this half hour, which is spectacular. We lost Robert Lucas, who's a giant. And what a privilege it was to interview him another time. Truly the giant of rational expectations, of questioning modern economics. Greg Mankiw said he was the single most important economist of the modern age. He wanted us to be rational. Out of a pandemic, are we rational in our expectations, or are we just making it up as we go? To me, there's very little theory going on here.
No, I think we are very rational. I think what we're doing with the banks is very rational. I think that our attitudes about work and remote work are somewhat rational as well. We needed a catalyst in order to maybe make us act on that rationality. That catalyst was we sent everybody home for a year, and then they said they kind of reassessed what they wanted to do but was afraid to do. And I think we are acting rational.
Who's got it right at the moment? BlackRock get back into the office or Deutsche Bank, who is seeking to cut office space by 40%? Who's got it right?
That's the question of the day.
I think all the BlackRock resumes are going to Deutsche Bank right now. and that's going to be the big push-pull between the firms that, I mean, is there a competitive advantage now by throwing that out there, that we have remote work and they want you back in the office 4 days a week?
They got this hybrid model over at Deutsche Bank, which means you have to come to the office, or rather, you go home 3 days of home office per week, right? 2/3 of employees have registered for that hybrid work model. 2/3. Which has meant they can slice office space by something like 40%.
Lisa, help me here. I have no wisdom on this at all. I have no idea where we're going.
It all changes when the labor market changes. If it doesn't get looser, then you know what? You're going to have this exact same kind of calculus.
Jim Bianco Research on the debt ceiling, coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Walmart is raising its annual profit forecast after posting better than expected earnings in the first quarter. Comparable sales easily beat Wall Street estimates. Still, Walmart expects shoppers to remain under pressure this year. President Biden is in Japan for the Group of Seven summit on Friday in Hiroshima. Leaders have a number of challenges ahead of them, including how to enlist nations outside of the group, as many countries have resisted sanctions on Russia due to pressures on their own economies. There's also the question of how to handle China, which is perceived economic coercion. Meanwhile, China's President Xi Jinping is holding his own summit. The two-day China Central Asia Summit will assemble the leaders of Kazakhstan, Kyrgyzstan, Tajikistan, Turkmenistan, and Uzbekistan. It's Xi's way of reminding the G7 of China's influence outside the U.S.-led world order. The state of Montana has now banned TikTok. That sets up the first legal and logistical test for broader efforts in the U.S. to restrict the widely popular video sharing app. The Montana law prohibits app stores from offering the app to people in the state, but enforcing the restrictions for current TikTok users could be more complex. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's
the perfect Goldilocks backdrop where it's a bit of food for thought for the bulls, a bit of food for thought for the bears. You know, the rate cuts are not being priced out yet because we in particular see U.S. headline inflation go towards 3% in the next couple of months. So, you know, you've got mixed data, but data on aggregate beating expectations, but not too much. Inflation heading lower. What more do I want?
Max Ken, bullish, still bullish, the chief multi-asset strategist over at HSBC. Your market, positive, just about by 0.1% on the S&P 500. Yields higher, just about by 3 basis points. Let's call it 360 now on a 10-year. On a 2-year, you can call it almost 420. Yields are higher right now by a couple of basis points on a 2-year, Tom. 4.176%. Let's call it 10 minutes away from the jobless claims number, 13 minutes away.
We'll be watching. I don't know if the Walmart CEO's watching. I love this headline. I have no idea what it means, John. What CEO speak is this? Walmart CEO sees inflection in ROI in coming quarters.
You want me to translate?
Yes, please.
Return on income.
He also says this. Signs of stress on consumers below the surface, and I think that's the more important piece of this right now.
Yes, I think so.
The trade down that we are seeing potentially from elsewhere, the fact that the average transaction at Walmart is up, but more shoppers are coming in as well, and they're coming in from where, Lisa? And that's the trade down story.
Right. Basically, people with higher incomes going to a place with lower prices because they just can't afford what they're being charged at other establishments that we won't name, or maybe we will for the rest of the show.
You're red and green on the screen. Futures up 5. I guess that's a good idea. VIX 16.87 gives me no information. Who does give me information is James Bianco, president and founder of Bianco Research, who does a really elegiac effort here on economics and dovetailing it into the state we're in. And then, as John mentioned, there's the debt and the deficit. I read Heilbronner Bernstein years ago, just the Bible on all some of our fears here. How afeared are you of the debt debate?
I'm probably more aligned with Wall Street. I mean, there's two types of people when you talk about the debt debate. There's those, to put it in Bloomberg terms, that Anne-Marie Horton would interview that would tell you there's a 40 or 50% chance that we're going to default. And then there's the Wall Street types that'll tell you that there's a 3 or 4% chance that we're going to default. And I'm probably in the 3 or 4% chance that we're actually going to see a default. We're going to see a lot of political theater. And I think what the markets heard from Speaker McCarthy the other day was that the president has appointed somebody to negotiate with him. So that means we're going to get a deal. And I think that a deal is largely expected in the market. And if there was not a deal, that would be the surprise.
So there's a market call to make as well in that. What is your market call around this story?
You mean around the debt ceiling?
Well, if you believe it's not priced, then you also believe, you acknowledge to some degree, there is some risk here.
There is risk.
Where do you think that risk is?
I think that risk is really in the short-term bill market. And I think that risk is potentially in the banking system. Remember that Treasury bills, Treasury securities are used as reserves. That's a fancy way of saying they're another form of money, is what they are. And if we were to default on those, we would throw the banking system into complete chaos because their reserves that they use would no longer be worth anything, at least for the day or 2 or 3 or however long we didn't pay them. That's the risk that you would face if we were to have a default. And there is a risk out there right now that if this negotiation falls apart, I don't think it will, but that is your risk. So you've got to use a fancy word, an asymmetric risk. If there's a deal, there's going to be very little movement in the market. If there isn't a deal, we're going to have to reprice the markets then.
Where there's a problem, the Fed has a solution, typically. Do they have a solution for that?
I don't think they do, nor do I think they should. This is a political issue, is what this is. We elected congressmen and senators to represent us, and if they're in their infinite wisdom decide to represent us by defaulting on its debt, we'll have to figure that out.
To your point, though, if that becomes a market functioning issue, doesn't the Fed have a role to play?
It does to some extent, but you also have to be careful that you're not undoing the will of Congress. Where does one end the other? That's why I think that this will get resolved, because it is all on Congress if this happens, if we have a debt default. It is not on the Fed for mitigating it.
What's the next crisis then? If this gets off the table, then what do people focus on next?
Well, I think we go back to focusing on the banking crisis. And I think we go back to focusing on, go back to the senior loan officer survey. Do we see lending, tighten up and continue to tighten up? And do we see problems then metastasize because lending is going to continue to tighten? And then I think the other one would probably be if, going with my forecast, do we see a bottom in inflation this summer? And then does the Fed come up short of their target? And does all the talk of cuts in the funds rate by the end of the year kind of go away?
Do you feel like people are exhausted by the pessimism? That they've heard the sky is falling for so long and it hasn't happened, that they're basically tuning it out and basically saying, yeah, you've been wrong, which is basically some of the messaging that I keep hearing. How much is that really kind of prevailing?
Oh, I think it's prevailing quite a bit. I mean, it goes all the way back to the pandemic when we had the ultimate pessimism. We were all going to die. That was what we had for the pandemic. And then we all didn't die. And then we've kind of recovered from that. So, yeah, I mean, I think there's a lot of frustration. I'll go back to what I said earlier. The markets haven't done anything. So no one is right, no one is wrong. The optimists are still waiting for the breakout, and the pessimists are still waiting for the breakdown. And this just continues, and the frustration continues to build.
If there is no debt ceiling default, right, and we do have that sense by the next Fed meeting, and we don't really have a sense of ongoing stress that's really coming to a head in the banking system, how much of a disruptive force would the Fed be if they actually did hike rates at the June meeting?
Oh, I think they would be a hugely disruptive force if they continued to hike rates. They would exacerbate the bank walk. I mean, this is becoming the national pastime right now, is pull out your phone and brag about your money market fund. It's no longer about a meme stock anymore. And that would just exacerbate that. And at higher rates will then definitely filter through in the economy. Count me for one that still thinks that rates matter, and that if the Fed wants to raise, I know that's a wild thought, but if the Fed wants to raise rates, it's going to really hurt the economy.
Brent, was everybody modeling a 6% money market fund? I mean, imagine that.
We actually, I think Lindsay Piegza was talking about a 6% Fed funds rate still on the table, even though everyone's taken that off. And then
triple lever cash.
Thank you. It's worked out well. We had a 2-20 payout last year. This year, I don't think we're going to do it. Ralph Ankapour, you're a CMT. You and I adore Ralph Ankapour.
I know Ralph.
He was on the show, and Ralph said October was the SPX bear market low. We're up 14% SPX off the Ankapour low. That, to me, is stunning. Nobody's talking about this. And a lot of people missed this lift off this low, didn't they?
Yes. So we're 6 months and 14% off the low. But I would also say, if you wanted to back up and look at the January high, we've only retraced half the losses.
Stay with me on my story here. Don't give me this technical analysis stuff. Go with the story.
Yeah, the market has lifted off the low, but what I'm saying is it's still well away from the highs, and it's been meandering sideways. So I see a market without a conclusion right now in terms of the sideways. It's waiting to see what comes next.
Remember the first time you read John Maggie? This is a textbook, John, written in 1940-something. You read Maggie, and it's support and resistance. And the bottom line, John, is you can make up any story you want. So I got a story. I'm coming from the October low, and the smart guy over here is going, no, you got to bring it back further, and it's not that glorious of a story.
Technical analysis of stock trends by John Maggie. So
my favorite story right now, allow me to share it with you. I can get behind this bill in Washington, D.C., the No Pay for Congress During Default or Shutdown Act. Do you like that? Doesn't that sound great? Awesome.
Who's the sponsor?
The sponsor, Representatives Abigail Spanberg, a Democrat, Virginia, Brian Fitzpatrick, Republican, Pennsylvania. Love that. Love that. So this is what NBC is saying. A bipartisan bill set to be unveiled today would block members of Congress from getting paid if the U.S. enters debt default or if the government shuts down. I think we're all on board, which means one thing. If we're all on board, they certainly aren't down in Congress, are they?
Well, this is revenge of the middle. This is revenge of the centrists, right? It's revenge of the guys. What are we doing here? Trying to gain political points and holding the U.S.'s future in hand.
Can you get behind that, Jim?
Oh, of course I can get behind that. I think we should go with when we hit the debt ceiling and retroactively stop paying them since January.
I've said all along, just pay them in T-bills. Just pay them in T-bills.
Pay them in January 1st T-bills and January 8th T-bills.
Who did you want to do that?
I wanted in the Eurozone debt crisis, they should have been paid in BTPs and in Greek debt. Pay the German politicians in Greek debt. That would have got things sorted quickly.
The most important message is Spanberger is ex-CIA, and she won her primary 50 to 48%.
Yeah.
She's in the middle. True. And that's what the middle of America's thinking.
Hey, Jim, this was great. Love it. Jim Bianco of Bianco Research. Next hour, Caterina Simonetti, Robert Tipp, Jeffrey Sherman of Double Line Capital. Looking forward to that. Jobless Claims with Mike McKee up next.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Bloomberg Surveillance, we say good morning to Lisa Bramwitz and Tom King. John Farrell preparing for another hour to move forward here through the morning. Futures running green on the screen, down a little bit negative. Fractional, it's eased up a little bit. The enthusiasm seen earlier in the morning, and the enthusiasm now goes to the economic data. There is existing home sales at 10 o'clock. But before that, the Philadelphia Fed Business Outlook, top of McKee's list. Forget about it, claims first.
Well, it would be great if claims would come out. Here we go. 242,000, which is down from the originally reported 264,000. We'll get the revision in just a moment, but definitely going in the opposite direction. Now, remember last week we had a big jump in claims, and then it was reported that a lot of that came from fraud in unemployment insurance filings in Massachusetts. So that may have gone away, and that may have accounted for this big drop during the month. The 4-week moving average, which would still incorporate last week, continuing claims, 1,799,000, but that is down from the prior week as well. So at this point, we are not seeing real change in jobless claims that would portend something for the overall labor market. Philadelphia Fed is out, as Tom mentioned. It is negative 10.4. Now, that's up from negative 31.3 months before. Remember, earlier this week, we had the Empire Index just absolutely collapsed, and people were worried about what that would mean for ISM, but now it looks like the Philadelphia Fed is going in the other direction now. What everybody wants to know is the prices paid index, 10.9 for the Philadelphia Fed. That
Positive
is up.
10?
Positive 10.9. That is up from 8.2, so that's not going in the right direction, which will set us up for our will the Fed, will they not in June debate. Prices received at a negative 7 versus negative 3.3. So it looks like people paying for materials and not at this point getting that back. And finally, the employment index, negative 8.6 versus negative 0.2. So it looks like the employment situation deteriorated a little bit in the Philadelphia Fed district.
Mike McKee, thanks so much. An eventful week, to say the least. And congratulations on talking to, was it 32 Fed speakers you talked to?
Something like that. 32. And I was told by...
You're a saint.
I know you've got Ellen coming on. I was told by Seth Carpenter, her co-head of...
Carpenter gets the golf trip sent.
He said to say hello to her and thank you for the advice about the sunscreen.
Very good. Oh, okay. 4.20, Lisa. We got to look at the yield up 5 basis points, and to go from 386, 387 over the last couple of days up to a much higher 2-year yield speaks volumes.
We were looking for unemployment claims to keep rising. They are going in the opposite direction. Is this enough for the Fed to hike further? And that's what I think the market is playing with. And not only that, but how much does this keep them from cutting rates? And you could see that in the Fed funds futures with now the idea of just sort of creeping higher, the idea that perhaps there's a greater probability that the Fed will remain on hold.
One of the piercing notes of the era has been out of this pandemic, where there was a belief in transitory, and one day the chief U.S. economist of Morgan Stanley said, I'm wrong, maybe it's not transitory, it's something new and different. Ellen Zentner joins us now, quarters on from a transitory economics. And Ellen, in your note today, you are framing out a new job economy. We are at a 250,000 run rate on non-farm payrolls, and you have a stunning observation of a path to 40,000 non-farm payrolls. How close are we to that?
Yeah, so I think we can hit that late summer, Tom. And, you know, look, you want to assume that things are linear, which they're never linear. Then if you look at the slowdown that we've had and just project that forward and say, knowing nothing else, let's just assume that continues, you would be down below 100,000 within a couple of prints. So, look, we see a slowing path for job gains here, but we don't see a cliff, and I think that's very important. Claims are still low. Companies are still doing more labor hoarding than they are laying off. We see an employment gap that still needs to get filled. And so I think there's a lot of support here that, yeah, let's be realistic. Things are slowing, but this is not a cliff that we're headed toward for job gains.
This is, Lisa, to me, the conundrum for you, me, and John into May, into June, into July, is we don't have a clue what as Ellen mentions, the linear flows here on labor. No clue.
Given the fact that it is slow, how does the Fed respond to a slow burn, given the fact that they are continuing to say inflation's our preeminent concern and inflation has been sticky? Ellen, can they afford to not hike rates again if we continue to see just a slow grind lower, but not that quickly, and inflation still higher?
Yeah, so Lisa, I think it's a good question. Inflation is moving in the right direction, but very stubbornly so, and it's not moved down clearly and convincingly as Chair Powell has wanted. But that was not a prerequisite to them stopping hiking, right? That is a prerequisite to when they make adjustments, say normalizing policy as inflation has come down a lot. So right now we think they're at the point where, yes, it's arguable on the Fed whether they are in restrictive territory. How far are they in restrictive territory? Are they close enough? We think that they're close enough, but the arguments that you, or the points that you make, would suggest that you need to keep that peak rate there for quite some time. And I think that's the argument that the Fed will lean on, that as inflation slowly comes down, but they're holding rates high, policy actually maintains its restrictive territory and in fact gets even more restrictive throughout the year. And I think that's what policymakers ultimately will lean on.
Ellen, we were talking about this earlier, and Tom asked the question, do we have a sense of what the new neutral really is? Do we have a sense of what it takes to really take some of the momentum out of an economy that has defied all expectations that were incredibly gloomy heading into the year? What's your view? Do we have a better sense of what that neutral rate is?
So I would say that there's, very cynical of me to say that neutral does not exist. We're never at neutral. We pass it up, and you know in hindsight whether you're at neutral, below neutral, above neutral. But we're always reaching for these sort of fictitious metrics or goals. What the Fed does know or can see is that things are slowing. We think they're going to be very slow in the middle 2 quarters of this year. And that's an economy with a backdrop of banking pressures, of volatile financial conditions that you might not want to push it further, but you want to maintain the option to hike again if you need to. And I think that's something that we have to consider. There are two-sided risks after the pause here.
Ellen, I got to rip up the script. You've done it with me before. Don't panic here. And the answer is we're going to talk to Ellen Zentner, foreign exchange strategist. Moments ago, euro dollar, solid 110 forever, just breached through a 108 to a weaker euro, 107.99 right now on euro dollar. To me, the great unspoken, along with your idea of NFP down well under 100,000, is resilient to stronger dollar. Dovetail that into your call. Do we get a resilient dollar again with the certitude out there, the consensus of dollar weakness?
Look, I think that currency movements are very important, and of course, where strategists are, shorter term tactically on the dollar matter a good deal. But I think there's going to be a realization here that the economy is not collapsing. And in fact, a realization that, yes, we think the Fed has paused here, but there are myriad options for policy after that, right? It's very easy to get inflation down from 7% to 4%. It's very difficult to get inflation down from 4% to 2%. And that might take more work from the Fed after they pause. So I think it's more of that realization creeping in that 5.1% is the peak now, but they may have to move higher at some point.
At least to me, this is so important, dovetailing in what Ian Lingen said with what Ellen Zentner said, and the idea of the asymmetric call, and this is frankly Hollenhorst as well. Do you get a symmetric call where you get rates up or the Zentner pause, and we don't understand the duration of that pause. And that's where you get the dollar dynamic to come in.
Well, and we also have the sense that Europe perhaps has seen the bulk of the gains, and perhaps there are signs that the other side of the trade isn't doing as well as the resilience of the U.S. economy. Ellen, to that point, we were talking with Jim Bianco of Bianco Research earlier, and one of the big fears about the U.S. was the banking crisis that wasn't, or the banking crisis that hasn't yet materialized. And he said it's too soon to say all clear, which a lot of people have been saying. Do you agree with this idea of a bank walk, of sort of assets just kind of tiptoeing out the door over a longer period of time, more akin to the 1980s S&L crisis, that still hasn't fully transpired?
Yeah, so I think, look, we've had a shock to the system. That takes time to flow through. I don't believe this is a credit crunch where we've just choked off the flow of credit to the economy, but it's clearly a credit cycle. And it's coming also from a drop in loan demand. So I agree. We can't assume that we're past, sort of these evils lurking around the corner. But I think one of the difficult things here, which is very different from the 80s, is that banks are now having to contend with sentiment. So think of a bank that's had an equity event, right? An equity investor does not want to own that stock. So the stock goes down, and then like clockwork, within days, outflows of deposits because you're suspicious of, is that bank where I'm holding my money safe? So it's a sentiment, and then you've got bank runs that move at the speed of light that are electronic now, and so this is all something that the banking system has to contend with, and I think will continue to weigh on credit availability and lending for some time.
Ellen, when you talk about the bank walk and later this year, does it become that much more sort of pronounced as a result of the Fed remaining on hold if the economy is also slowing at a commensurate level? So basically, the relative yield that you're getting on those T-bills is that much better.
Yeah, so look, I think for banks, it comes down to liquidity. And you can look at it one way and say, well, banks are accessing the facility that the Fed has put in place, or they might be accessing the discount window. But ultimately, the other side is the way I would look at it, is that's a good thing. Banks need liquidity, and they're accessing it. And so that alone will help banks work through this.
Ellen, I wanted one final question. There's a guy named Gorman. I think his first name's James Gorman, and he said a number of months ago something like, and he said it with that accent he's got, that that Australian thing going. He said, with some fury, if they can eat in a restaurant in Soho, they can come to work. I'm fascinated at what you see nationwide on back to work. It's a big debate in Manhattan, but are we going to go back to work in America?
So we are going back to work. I think when I've traveled around the country, I find a good deal of regional differences in terms of people that are back to work full-time, almost full-time. Look, why does this need to be a worry? I mean, yes, office space for commercial real estate is working through problems, resizing. It's more of a tier B and tier C market than a tier A problem. But still, we don't have to be in 5 days a week. That's not what new work arrangements need to look like. But we do need to connect.
See you in a restaurant in Soho. We'll try to ignore Mr. Gorman if we can. Ellen Zentner with Morgan Stanley, working for the James Gorman. Coming up, lean forward on the media, on the changes in Hollywood. Jessica Reif Ehrlich will join us with Bank of America. She is definitive on Hollywood. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden and other group of 7 leaders have begun arriving in Japan for their summit. China and Russia will be the problems at the top of their agenda starting Friday. Russian President Vladimir Putin continues his war in Ukraine, and a post-pandemic China is busily expanding its economic and strategic clout. Meanwhile, China has kicked off a European tour aimed at brokering peace in the war between Russia and Ukraine. A top Chinese diplomat met with Ukraine's President Volodymyr Zelensky this week. Li Hui told Zelensky that ending the war would require all parties to build up trust. Ukraine has said it won't accept proposals that include the loss of territory. President Biden hopes to be reelected next year by defending his victories in 2020 battleground states. But he also wants to expand the map into states like North Carolina and Florida. In a memo obtained by Bloomberg News, campaign manager Julie Chavez Rodriguez argued that Democrats strengthened their hand with their performance in midterm races and in this year's special elections. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
To do to continue to develop features that support advertisers. We're rolling out things like measurement and verification, but we've got a bigger, longer roadmap that we have to go do there. We'll be working with advertisers and members to try things and then let them tell us what's working and what's not. Scale is relevant in the business, so we have we're getting to a certain size of scale that shifts how advertisers think about us.
Greg Peters with Netflix, their co-CEO. All I know is scientific research, Lisa. Netflix is on at the Keene household. There's like 14 streamers, and that's the one that gets the most FaceTime.
What's the show?
Oh, it varies. There's like Addams Family Redux or whatever. It's been successful. They've been on a roll on a creative basis, to say the least. For Global Wall Street, and particularly for those focusing on what we consume at home, she is definitive. Jessica Reif Ehrlich joins us now, senior media entertainment analyst at Bank of America. Forget about all the titling. Here's the bottom line, folks. She had to get a restructure done on the living room mantle because 14 times she's taken home the trophy of institutional investor. All you need to focus on, folks, I don't know anybody that's ever done that. Jessica, honored to have you with us. In the old days, you'd wander out to Capital Guardian Trust. You'd talk to Gordon. You'd think about, Comcast. What are they going to do with free cash flow? It's all been blown up. Hollywood's a train wreck. Where's the opportunity?
Well, I think you guys just hit the nail on the head with that Netflix clip. They are clearly going to take share. There's just not even a question. Look at the engagement on their platform. They're just beginning to roll out advertising. It will be uncluttered, so 4 to 5 minutes an hour, with a highly engaged audience, relatively young, addressable, targeted. So there's a very, very long runway here. But I would say if you step back, AVOD, or advertising video on demand in general, is where the share gains will be. So Netflix is going to be a winner over the next 3 to 5 years. But so will some other companies. Warner Brothers Discovery seems to be very well positioned. They're rolling out Max next week, May 23rd. Disney's platform will get bigger when they roll in Hulu. So there are some major in this area.
To go to the current chit chat, Jessica, the upfronts just happened. This is where everybody rolls out stars and smiles. You've seen so many of them. It's like, yeah, okay, no big deal. How did Warner Brothers Discovery do in an upfront FaceTime of the mating of those two dinosaurs? How did Mr. Zavlev do in identifying a new WBD?
I thought they did a great job. It was their second year, their second upfront as a combined company. They had all of their management team. Of course, nobody had talent this year because of the WGA strike. But they did a great job. They did a great selling pitch, why advertisers should come to them. Their product is really broad and really deep. They have the best library. It's a big library, but it's the best library. And they have a lot of originals that people look forward to.
Will we see a mating of streamers? I mean, I looked at I think it was in Variety. I looked at a percentage of people getting eyeball time with Lisa's kids, and there's like Netflix and that, and all the others are really behind. Do they have to merge to survive?
Yeah, I mean, Netflix is so far ahead of everybody else that it's no competition and no comparison. I mean, their engagement is humongous. The scaled players are Warner Brothers Discovery, Disney. Not to say that Warner Brothers Discovery can't get bigger, they can. And the other players, our view is there will be consolidation.
Going forward, there's a real view on the consumer as well. We've been talking about that a lot this morning, about the state of the U.S. consumer. How much pushback is there on cracking down on password sharing and this concept of people continually willing to pay more for some of these services, even at a time of potentially constrained income?
Well, what's interesting here is that Netflix is not raising prices this year. Their price increase or their revenue driver will be the crackdown on password sharing. And they have a relatively low-cost offer. For $6.99, you can take Netflix and get two streams. You can download high quality. So they've improved the product that they're offering as long as you take ads. If you don't want to pay, it's $9.99 for the lowest price. But $6.99 for all of that content is fairly compelling. And the crackdown, basically when they crack down in the U.S., which will be this quarter, if you're a password borrower, as they call them, if you're not paying for your own account, you will be cut off. So there's a choice to be made. Do you want to pay $7 a month and get all that content, or go somewhere else, which is more expensive?
Tom, this sounds like one of those ads. It's only $6.99, but wait, you get some advertisements. And Jessica, I do wonder if that's really where this is going, that basically the marginal income will continue to come from advertising, that advertisers will flock to these platforms, and that consumers, as they bump up against those price pressures and password sharing crackdowns, will be willing to accept advertising that initially they weren't.
Well, while there's resistance to advertising, thanks to Netflix, the reality is that it does pay for a lot. And these are highly engaged consumers, and so as consumers move from linear to streaming or to digital, the advertisers have to follow. And for consumers, it's it's uncluttered. On linear TV, we're getting 15+ minutes an hour. On streaming, it's basically 4 to 5 minutes, depending on the streamer. But with Netflix, Warner Brothers Discovery, and Disney, it will be in that zone.
Right.
And so for 5 minutes targeted advertising, I think consumers will.
Jessica, I just did a 25-year survey. This is the first time Jessica Reeve Cohen won the Institutional Investors Award, and I just did a regression in Netflix, and they're down almost 2 standard deviations from the glory days. To get to the center tendency, Lisa, Netflix goes up 145%. Jessica Reed-Ehrlich, is that the vision you have of Netflix, like literally having a double capability?
I mean, it depends on the time frame, but yes, if you have a multi-year time frame, this is the stock to own. I mean, even in the near term, we love it, but yes, I mean, this is a stock that can. Well, even look, there's two major obvious drivers, which are password sharing crackdown, which will be a huge driver here next, and then advertising, which will be a 3 to 5 year driver. Not to mention their content has just been off the charts. Literally, they dominate.
Jessica, thank you so much. Honored to have you with us. Jessica Reed-Ehrlich, one of my heroes with the Bank of America Securities today. Lisa, that's a scope and scale. And the adults in sell side, like, you know, Ben Laidler at HSBC and now with eToro or Jessica Reed-Cohen, they're iconic, absolutely iconic. Their scale is they're not looking 6 months out. She's looking at Netflix as an extrapolation out 12 months, 3 years, 5 years, and like Michael Nathanson say at MoffettNathanson, all of a sudden these ginormous stocks are like a double if you believe in the story. I'm not advocating that, but that's the scope and scale.
There's been a massive transformation, no doubt, in terms of cord cutting and just the way that people consume media. It was expedited during the pandemic, but as we settle out, it's clear that there are some structural shifts, and who's the winner and who's the loser is going to become apparent as we move forward.
Don't you just look at what's going on at your house? That's what I do. I mean, they're watching.
I try
Netflix.
not to.
Yeah, really.
I try not to know.
No, that's true.
Especially as they continue with their screens.
You know, I get the Disney Plus, you know, the young kids and all that, and you know, we don't have the you know, like pineapples watching Disney Plus 24/7. One of our staff's friends, daughters rather, you know, but they're watching Netflix. That's all I see. When I walk by, it's Netflix.
Can I just bring you this? Lori Logan was speaking of the Dallas Federal Reserve, and she said the current data does not justify a pause. This seems to be a growing feeling among a certain cohort on the Federal Reserve. Perhaps this is just talk to push back against some of the rate cuts priced into the market. But you are seeing that grind higher in the 2-year yield, now 4.23%. But how much they're just seeing the mess. And this sense that, you know, the economy isn't doing so badly. Retailers are doing just fine. And there's a story here that they can't really lean against, but just saying, but wait, what about the banks?
Yeah, and you see that with the, this is critical, the vanilla spread. We've talked about a lot of different comparison of yields today in the 2s, 10s, the difference between the 2-year that Lisa was just mentioning and the benchmark 10-year note critically goes through 60 basis points of inversion. Now, negative 61. I haven't done the technical work, but, you know, I defer to Priya Misra on that, among others. But the answer is, you know, you go through 60 basis points, that's a benchmark. The real yield up 4 basis points, 1.38%. Maybe not a breakout, but nevertheless, this is percolating. And I'd also mention, you know, away from the China gloom and that, we were waxing philosophical about $69 West Texas Intermediate, 72.38. A nice little lift in oil as well.
Yeah, just jobless claims aren't ticking up. I mean, they went down from 264,000 from the prior week to 202 to 242,000. A downside surprise amid a market that's supposedly, a labor market that's supposedly loosening.
The debt ceiling, it's part of the topic at Hiroshima, Japan. Anne-Marie Horton is with the president in Japan for the G7 meetings. That debate continues. The senator from Arizona will do that in the 2:30 hour. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, The only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Things getting interesting again. The data, okay. Is June back in play? Yields are higher, the dollar's stronger, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, coming up, the president feeling confident he can reach a debt deal. Another data point speaking to U.S. economic resilience as this week's Fed Speak Marathon resumes. We begin with the big issue, pushing out the recession calls. 1 year on from the Fed embarking on its aggressive hiking cycle, taking rates from 0 through 5%, Fed speakers are lining up once again today to defend their position. As inflation is still sticky, consumers are holding up, the labour market is resilient, and the housing market is showing signs of life. Even the Atlanta Fed GDP tracker is now running close to 3%. As Kit Jukes of SocGen says this morning, throw in some debt limit optimism with that decent data, and the pricing of rate cuts and dollar shorts are beginning to feel the squeeze.
We've been talking about the risk of a user recession for some time.
Will we have a recession or not?
We don't expect a recession in the US.
This recession has proven indeed very elusive.
We're not in recession in the first quarter. We're probably not going to be in recession in the second quarter.
We're not seeing the whites of the eyes of it in hard data.
Indicators have remained very stubbornly robust.
Employment and consumers still fairly resilient.
Consumers are proving resilient.
The consumers are hanging in there.
The equity market has earnings starting to reaccelerate and rebound.
Inflation is actually still, still reasonably robust.
That's a problem for the Fed.
The market is a bit premature in expecting rate cuts this year.
They don't have the ability to do that with inflation where it is.
They're still focused on inflation. That has to be number one.
The threshold for the Fed to cut is going to be high.
Let's get to the Bloomberg team. Enda Karen in Washington, Mike McKee here in New York. Enda, you wrote about it this week. We're pushing out those recession calls.
Yeah, so we polled 27 economists, John. Of those 27, there are only 5 who do not see a recession over the coming year, but the rest of that group keep moving the goalposts. They keep moving back their calls quarter by quarter, and that's because the narrative keeps changing. The data's holding up, like you mentioned. Consumer strength is still there. Inflation's coming off the boil. Housing market showing signs of stabilization. So the broad story was that the US was expected to be in recession at some point this year, but now, according to our poll of economists, only, even of those who call a recession, they continue to push back their timing, given the way the economy is holding up.
Mike McKee, is June back in play?
June's back in play. If you've been watching this show over the last week, you know, down in Florida, I talked to a number of Fed officials who really did not want to say we are going to pause. And now we've got a new one to add to the list. Lori Logan, the Dallas Fed president, out this morning with a speech in which she lays out the case for holding or going farther with the Fed funds rate, and concludes with this. The data in coming weeks could yet show that it is appropriate to skip a meeting. As of today, though, we aren't there yet. So expect more of that, and expect more Fed speak to push the idea that don't take raise off the table at this point. Got a number of Fed speakers yet to come today, tomorrow, and early next week before they get to the blackout period, including on Friday, Jay Powell, the Fed chair, today, Philip Jefferson, the Fed vice chair designate. So look for all of this Fed speak, and perhaps trade a little bit away from the idea of Fed cuts or a Fed hold, and see what happens with the data.
Mike, I said it's getting interesting again. What's your takeaway from this week? You've caught up with so many of these individuals. I just sense that things are starting to splinter on the committee just a little bit.
I don't think so much you'd call it a splinter. There are some who lean towards a pause because they're concerned about how far they have gone and how fast. And there are others who think we still have to tighten some more. It's only a question of when. And that debate won't be resolved until we get very close to the date. After all, they get CPI the day before the Fed decision.
Mike McKee, thank you, sir. And Karen, and I love the piece with Reid earlier this week. Fantastic. Fantastic piece from you and the team on Bloomberg.com and on the Bloomberg Terminal team as well. Let's get straight to this market. Equity futures breaking down just a little bit on the S&P 500. We turn negative off the back of that jobless claims data. Yields higher every single day this week at the front end. Monday, Tuesday, Wednesday, Thursday this morning. Yields up by 8 basis points on a 2-year through 420. The euro, a break of 108. 107.88 on that currency pair. Euro dollar, we're negative by 0.5%. As Mike indicated, opening the door potentially to June. Fair bit of data between now and then, but ultimately that's what we're talking about now. Citi's Andrew Hollenhorst sees things heading in that direction. He writes the following this morning. The hike probability is rising as Q2 real GDP growth looks increasingly likely to come in stronger than Q1. He referenced the Atlanta Fed GDP now forecast, something I know many of you have been looking at, just shy of 3% at 2.9%, with housing no longer a drag on growth after a third consecutive month of rising single-family building permits. Let's talk about it. Morgan Stanley's Caterina Simonetti, PGIM's Robert Hipp. Caterina, to begin with you, are we opening the door to another move in June?
Well, Jonathan, thank you for having me on the show. And this certainly is an interesting time in the market. Earnings have been pleasantly surprising, but is this enough to really carry us into another bull market with all these risks on the horizon? We have the debt ceiling situation, and this is just one of the components. There's also, the question, is inflation going to be sticky? When is Fed going to be done raising rates? And is this going to be really enough to pivot us out of that risk, which that we're all concerned about, which is, the recession. So with all the questions on the horizon, we're expecting heightened volatility, especially with this uncertainty until the debt ceiling situation is resolved.
Robert, what do you make of the progress we're making in the economic data at the moment? Housing this week, signs of activity, okay. Retail sales, okay. Claims have come back in. Industrial production, decent, not too bad. How would you characterize things in this economy?
Things are fine. I think the mistake people have made is to assume that the natural state of the economy is going to be recession, and that anything that crops up that hits the economy, that hits the growth picture, is going to result in recession. And, and they've been so strong on that conviction that they're not really parsing the data. And what the data is telling us is that the neutral interest rate has probably moved up a lot, and this economy has powered through a big correction in residential real estate. It's probably powering through right now the slowdown in commercial real estate, but also the banking jitters. So I think that, you asked the question about, is June live? The Fed has hiked a lot. All of the central banks have hiked a lot. Their need to hike from here is, it may still be there, but the pace of hikes are going to be much slower, and they're going to be very cautious to make sure that they don't overshoot. but I think that's the realm that we're in, of moderate growth and stable central bank policy, maybe some more snugging to go. That's what it looks like.
To be clear, there's certainly a range of views at the Federal Reserve right now. We're just hearing from Governor Jefferson as well, who says, my expectation is that the slowing economy will soon begin to reduce job growth. With labour supply and labour demand coming into better balance, the unemployment rate may rise gradually to levels still consistent with a growing economy. We've got a range of views on this committee right now. Logan certainly opens the idea that we hike in June. Jefferson may be leaning into that pause. Katarina, for the bear market is clear. Year to date, serious upside relative to what we expected, driven by some big tech names doing big things. Futures softer this morning, but your take is still the same. You believe this bear market is incomplete. Katarina, why is that?
Well, Jonathan, market is showing an incredible resilience in face of all this uncertainty and negative news, and this is not something that we can discount, but we can also not take away the risks that are still in the market. And most importantly, the positioning of the Fed. They're in the really tough spot. The big decision for them is the timing, because once they announce that they're done raising rates, market is just going to assume that, that they've succeeded, and it might not necessarily be the case. High interest rate environment might be our new reality. Inflation so far is proving to be sticky. And I agree with Robert that, while we might not get a recession, it still is the risk that has to be strongly considered. So we're telling our clients to stay defensive, to focus on yields, to focus on dividend-paying stocks. But we also are telling them to be opportunistic, because we know that no bear markets last forever. There is a light at the end of the tunnel. We just are uncertain on the timing. So while we're positioning the portfolios for the recovery and are being opportunistic, taking advantage of the dips in the market, we're also, for the most part, staying defensive.
Well, sector selection has been everything this year. S&P 500 information technology up something like 25% year to date. The banks on the S&P, as you know, are down by more than 12%. Elsewhere, the regional's down even more. Katarina, would you lean against some of that? Which way would you be leaning, just in terms of your sector preferences at the moment?
Jonathan, sector selection and security selection is absolutely essential in this type of market. We're looking specifically for names of companies that have the pricing power, that have the resilience to do well in this market, and also strong competitive advantage all across the board. We're not discounting any sectors. While we might be strategic, for example, in this time of uncertainty, energy and utility stocks might do well, while we don't know what is going to happen with the debt ceiling, and we're facing possible, liquidity, the crunch, and further pressures on the market. But over the long term, we love healthcare, we love technology, we love the consumer staples, and there are a lot of buying opportunities. And the market uncertainty presents opportunity. We just need to expand our time horizons a little bit and positions ourselves for being protective, but also to make sure that we are in the right place when market recovery, is strongly embedded.
Robert, in fixed income specifically, what are you and the team advocating for?
Yeah, I think you need to build a bridge over this market. I mean, there's a huge opportunity in that yields are up a lot. But the market is priced for recession and rate cuts that probably, it's a very high hurdle. You have to really get that recession, get the Fed shifting gears, cutting rates, to make money by buying the middle of the curve that's already priced in those rate cuts. So I think you need to build a bridge over that between your higher yielding floating rate product, like your CLOs at the front end of the curve, maybe some lower quality issuers you can get comfortable with further out on the curve. And, I think that while, stocks have probably bottomed out and they're moving higher, it's a tougher growth environment. That tough growth environment, though, moderation could be very good for fixed income. And so there's a lot of opportunities, I think, to get those 5, 6, 7% kind of return opportunities in fixed income by being selective, looking for the best ideas in each area.
We'll talk about what that means for Treasuries. Robert Tipp, Katerina Simonetti sticking with us. Treasuries right now selling off, just a bit softer this morning. Yields higher off the back of better data and some hawkish Fed speak from one Fed speaker in particular. Yields higher by 7 basis points, back through 420 on a 2-year. We are about 18 minutes away from the opening bell with some movers. Here's Abby.
Well, as expected, John, Walmart put up a big quarter, a beat and raise quarter. This had been the expectation, especially compared to some of its peers with with its value offering. Earnings were better by 12%, sales better by 2%. The outlook was raised, but what it does make it interesting, the company's relatively conservative, and they are still cautious on the U.S. consumer. As for some of the tech movers on the day, NVIDIA, Susquehanna, and Oppenheimer have both raised their price target to $350 on the stock, suggesting nice potential, upside potential could be ahead. Earnings next week, and of course, this company getting a big boost from AI. Amazon up about 0.8%. They're making a roughly $13 billion cloud investment in India by 2030. And then finally, Cisco, the networking company, down 4.7%. Now, it's interesting because they raised the outlook, and we all know that that's such an important deal, but they saw weaker enterprise orders in the quarter that was. Typically, or often, John, Cisco leads the broader economy. So this is an important one to watch to see if this is a real sign of weakness for the enterprise and the corporate customer.
Abby, thank you. We'll discuss that name around the opening bell in about 17 minutes' time. Allow me to share this with you. One of my favorite strategists on Wall Street, Neil Dutter of Renmac, has this to say. Growth bears, heads I win, tails you lose. Says this: stock market and economic growth bears have no logical consistency to their views. The economy is weak, earnings will tank, and the Fed's cuts won't be enough. Now, it is the Fed is not backing off because the economy is too strong, so interest rates will need to be higher. Beyond pathetic. Ultimately, that's the story of the moment. Yields are higher on a 2-year at the moment, pushing higher by 8 basis points, 423 on a 2-year, and equities are lower by 0.2% on the S&P 500. Your opening bow just around the corner. Coming up next, more happy talk out of Washington, D.C.
I'm confident that we'll get the agreement on the budget, that America will not default.
I'm optimistic for America because of the people standing behind me. I'm optimistic of our ability to work together.
That conversation up next.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be. The happier you will be.
Confident that we'll get the agreement on the budget, that America will not default. And every leader in the room understands the consequences if we fail to pay our bills. And it would be catastrophic for the American economy.
The president with some constructive words before departing for the G7 in Japan. A simple message: America will not default. Speaker McCarthy exuding confidence as well, despite seeing plenty of hurdles remaining.
I'm optimistic for America because of the people standing behind me. I'm optimistic of our ability to work together. Do we have obstacles? Yes, we have a big obstacle in the White House. but we're going to change the course of history because we're going to stand for the American public.
Speaker McCarthy telling reporters getting a deal done this week is, quote, doable. This coming as big bank CEOs meet with Senate Majority Leader Chuck Schumer. JP Morgan's Jamie Dimon saying his bank is prepared for any potential outcome.
Everyone wants a strong financial system. Whatever it is, we will be prepared.
We will be prepared. It's all good for the mood music, not so good for the Treasury's cash balance. According to data published on Wednesday, it's sitting at around $95 billion, up from a day earlier, but down from $140 billion at the end of last week. Joining us now is Bloomberg's Anne-Marie over in Japan. AMH, walk us through the latest.
Well, the latest, Jonathan, is the debt ceiling negotiations are obviously a little bit of anxiety here at the G7 as well for foreign leaders, as the president is going to be sitting down with his peers, especially talking to them about getting on board what the U.S. wants to do in terms of vis-a-vis China. At the same time, these leaders are concerned about their own economies and protecting them if the U.S. were to default. So obviously, the president is going to be, as he said before he departed, he's going to be in contact with his negotiators in Washington. It's a smaller team. They have the authority to really hammer out the details with Republicans, but it's looming large on him, and it's even meant that he had to scrap part of his trip. After Hiroshima, he was supposed to go to Papua New Guinea. He was also supposed to go to Australia. I think all eyes are also going to be this afternoon on Washington with the Vice President Kamala Harris alongside Lael Brainerd is going to be giving a briefing about where they stand on these debt ceiling negotiations. And it's something obviously the president and his core team here at the G7 are watching.
Anne-Marie, as you watch things play out, is this just improving mood music, or can you identify something specific that you think we have made some progress on?
Well, I think the fact that it's a narrower group of individuals that are having these negotiations, that a number of leaders have come out on both sides of the aisle and say, we will not default, that does seem like they are making progress. The president also did have a moment where he said he does not want to see work requirements, Jonathan, when it comes to access to medical care. But he didn't say that about other issues. Work requirements are a big issue for the Republicans in the social safety net, but he didn't draw a red line for anything else. So you do see potential movement from the White House. The issue, of course, is going to be, once they hammer this out, are they going to be able to get the votes through Congress? But of course, if this is a deal done by Republicans and Democrats, then you're going to have both sides likely signing up to vote for it. But obviously, the concern is, Jonathan, and that is not lost on the global leaders here in terms of the risk they see to the global economy, is that June 1st is fast approaching.
Here we go again. AMH, wonderful work this morning. Looking forward to your coverage for the next couple of days. Anne-Marie in Japan for the G7. Back with us for a final word, Caterina Simonetti, Robert Tipp. Robert, I want to come to you. Do you think we need to get closer to a crisis before we find a solution?
I don't think so. I think that Biden has really taken a very powerful course here. We've heard more about the 14th Amendment than we have in the past, directly from the top. And I think that was his way of saying, come to the table, you give me something, I'll give you something. Otherwise, I'm going to roll over you. I'm going to prioritize and I'm going to make these payments. I'm not going to be the person that defaults on the debt. So I think that's why what it looks like to me is they've both come to the table. They've given each other something to work with. They're going to put this thing to rest, and we're going to move on.
Caterina, can you move on?
Robert, the key is we must be prepared. As we hope for the best, we must prepare for the worst. And the beauty of this situation is that for the last 10 years, we were in zero rate environment, and it's no longer the case. We have higher yields in both cash and liquid assets and in fixed income, and investors who desire that safety, certainly have options right now and can get pretty higher yields for it. But we must also prepare for the fact that, there might be a resolution, there will most likely be a resolution, and, what it means going forward for the market and for our portfolios.
Where would you expect that relief to be in the market specifically? Did we get a stress test of that? A case study, if you will, yesterday?
Well, when we look historically, we've had situations like this before. They're all very different, of course, but there is general expectation from investment public that this is something that is going to be resolved. And, the key here, actually, to be prepared for the negative outcome, for that pressure on liquidity, for the pressure on the markets that will result if there isn't a resolution. If there will be, it will be a positive impact. We're going to see that little bit of an influx of positivity in this environment of uncertainty, which will be great. That coupled with positive earnings will actually be quite a nice tailwind for the market.
And that's the constructive view. Robert, you're pretty constructive on the outcome of this as well. Given the disconnects in the T-bill curve at the moment, is there anything you like, anything you're doing actively at the moment to take advantage of that?
Right. I mean, I think there have been some tactical opportunities in the CDS, especially in the curve, the credit default swaps on the government. I think that, the markets, the best way to approach this, I think, of course, yes, you have to prepare for the worst and what would be your settlement issues and so on in the case of a default. But it looks like this is moving away from that. You have to go back to economic fundamentals and not lose sight of where we're going to be 6, 12, 24 months down the road. What is the best strategy for that environment? And I think within that, fixed income generally looks attractive, and there are a lot of opportunities within the sectors. You don't want to get unduly bogged down.
Robert Tipp, Katerina Simonetti, the two of you. Thank you. We're about 7 minutes away from the opening bell. Equity futures trying to bounce, still negative 0.1%. Yield still a lot higher by 6 or 7 basis points at the front end on a 2-year 4.22. Up next, the morning calls in later. Double Line's Jeffrey Sherman recommending investors start positioning for tougher conditions and selling the rally in junk bonds. That conversation just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Europe. Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
Equities just a little bit softer here. Let's get to the morning calls. Your first call from Truist, downgrading Procter & Gamble to hold, 155 price target, seeing limited upside due to a lack of upcoming catalysts. Evercore upgrading Teva Pharmaceuticals to outperform, pointing to the company's strengthening pipeline. And finally, Morgan Stanley raising its United price target up to 75 a share, expecting China's reopening to unleash a wave of potential travel demand. That stock is just a bit softer in early trading. Coming up, Walmart raising its annual profit forecast, but delivering a word of caution about the consumer. That conversation's still ahead. We'll catch up with Double Line's Jeffrey Sherman. That conversation up next.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We have been on a bumpy road to absolutely nowhere on the S&P 500 through most of this year. On Tuesday, the biggest one-day drop, I think, since May 4th. And on Wednesday, the biggest one-day pop, move higher since May 5th. Your equity market right now just slightly negative by 0.1%. The data is okay. Are we opening the door to a move in June again at this Federal Reserve? There's your opening bell. Switch to the board and get to the bond market. It's driving yields just a little bit higher by 5 or 6 basis points on a 10-year, back through 360, 361.91. In the FX market, it's driving some dollar strength. The euro, a break of 108, 107.88. We're negative on that currency pair. Euro dollar by 0.5%, and crude a little lighter as well, 72.36. We're negative there by 0.6%. About 20 seconds into this session, your equity market slightly negative on the S&P 500, slightly positive on the Nasdaq. The one stock to watch at the open, Walmart, the retailer raising its full-year profit outlook, but delivering a word of caution, expecting inflationary pressures to linger. The CFO saying this: there's reason to be somewhat cautious on the health of the consumer. Abby has more. Hey, Abby.
Hey, John. Yeah, it's an interesting quarter, and right now investors are rewarding the stock, popping, having its best day in more than a month. So relative to the quarter, they beat adjusted earnings by 12%. They beat sales by 2 or 3%. So pretty solid. Now, the outlook, I'm getting different reads here. One analyst is talking about how the second quarter is a little bit light, but still strong. They basically held, but because of cautious activity that they're seeing out of consumers, they are not raising the guidance in a big way. That said, they're doing a little bit better, it seems, than some of their other retailing peers, such as Target. Now, of course, they do have, because of the economic environment, more shoppers who earn over $100,000. There's headlines out now saying some of those shoppers are going toward discretionary items. But we have Adam Crisafulli over at Vital Knowledge. He's saying that these results aren't perfect, that there was general weakness in merchandise sales as shoppers are pulling back on discretionary goods, plus lower gross margins, moderating gains in food sales, and a second quarter profit forecast. So I'm going to be curious, John, given the variety of commentary out there, whether or not these gains hold. But right now, up 2.4%. It seems that investors are choosing to see the Walmart glass as half full as opposed to half empty.
2 minutes in, slightly higher, as Abby indicated. Let's see if it sticks. Abby, thank you. Also looking at shares of Cisco, under pressure after reporting a 23% decline in orders this past quarter. The CFO saying this: what we are seeing from our customers is they are being prudent. Isabel Lee joins us now for more. Morning, Isabel.
Hi, John. Shares are indeed falling. 23%, that's not really a lot. And Morgan Stanley said orders slowed faster than expected, but still largely in line with their recent checks. But perhaps this isn't so surprising given that Cisco is the largest maker of machines that support computer networks and the internet. But there is some good news here. For instance, they had strong sales forecasts and overall positive analyst projections. Its CEO, Chuck Robbins, maintained that demand is steady and that the improved supply chain is giving customers more confidence to purchase equipment. He has tried in the past to recast the company as a provider of software so that he will encourage people to keep on buying and bring in recurring costs apart from that one-time purchases. So we'll see how that plays out for now, John.
Let's see if the name recovers. Isabel, thanks for that. Cisco's still lower by 2.6% about 3 minutes into this session. Let's shift the focus to Alibaba, the e-commerce company approving the spin-off of its cloud services division. Kelly Lyons has more. Hi, Kelly.
Hey, John, yeah, the stock opening more than 3% lower all the same. This spinoff of the cloud division will happen within the next 12 months via a stock dividend distribution to shareholders, and the intention is for it to become an independent, publicly listed company eventually. Now, it's worth noting that this announcement came in the context of the company's fiscal fourth quarter report, in which this division saw revenue actually down 2% versus estimates of 6% growth. You also saw a decline in growth in its China commerce business, so speaks to some of the underlying issues Alibaba is dealing with here, hence why they are looking at unlocking value in these different businesses. Not only will the cloud division be spun off, they also are beginning to pursue IPOs for its grocery division as well as its logistics arm. The company is also planning to secure external financing for its international e-commerce division. So taking steps toward unlocking this value, John, but still the stock not liking what it is seeing in terms of that growth. The revenue growth of just 2% in this quarter is the 6th consecutive of less than 10% year-over-year growth. So Alibaba is just not a company that is growing like it once was. The stock down 3.3% at the moment, John.
Just a bit softer, early part of the session. Kelly, thanks for that. Here's a stock doing okay. In the financials, PacWest extending gains to a second day. You can thank Western Alliance by reporting higher deposits. That really sparked a rally in the regionals in yesterday's session. In focus today, once again, we should hear from the Vice Chair of Supervision, Mr. Michael Barr, which means we're going to hear from Sonali Basak right now. Morning, Sonali.
Good morning, John. I don't know that the easing of the regional banking system here, the strongest rally you've seen in a couple of years yesterday, I don't know that that takes the pressure off of regulators down in Washington. However, it certainly takes some of the pressure off of the stocks. You saw PacWest up more than 20% just yesterday. You are seeing more of a bump today. You're not seeing a widespread gain. And again, you and I have lived the same last couple of months here, and we know that these have been very, very volatile. A couple of days don't mean much. However, you also have, for example, the likes of a Schwab selling investment-grade bond late Wednesday, $2.5 billion actually for better terms than initially expected. So that shows you an easing of the capital markets for the banking system in particular. Now, we know when it comes to the broader ramifications here, there's actually some benefits of private capital stepping in and taking in some of the lending capacity here. It eases some of that worry of the broader credit crunch. But again, remember, there are still massive holes in this market and a lot of jittery feelings about what the sector looks like right now. But a little bit of pain off the
We've
table.
heard a lot from regulators, as you know, and excuse me for jumping in, but I just wanted to be clear and keen to get your take on this. What do we know about the next regulatory steps? I saw a lot of politicians down in DC making YouTube videos for their constituencies for their next political campaigns. What do we know about the next real concrete regulatory steps?
It's a great point, because when you watch the hearings, they're kind of disappointing, aren't they? They're blaming inflation, they're blaming the Fed, they're blaming a whole lot of things that maybe doesn't matter to the banking system that still exists. But with that said, you might see some changes in terms of the way executives buy and sell stock around certain big events when it comes to the banking system in particular. We're not seeing wholesale changes when it comes to short selling. You will see a very interesting stress test this summer when it comes to the existing system. And the question is, do they widen those tests to a wider set of banks in the future?
Sonali, thank you. We'll catch up with you in just a little bit. I've been looking forward to this conversation. Jeffrey Sherman of Double I Capital joined us now to talk about this market. Jeff, wonderful to catch up with you, sir. Let's start with the data this morning. I had this conversation at the start of the hour. Are we opening the door to another move in June at this Federal Reserve?
Well, I mean, if you look at some of the data this morning, too, the unemployment claims really continue on kind of an upward trajectory. And so if you look at the initial claims at roughly 250,000, it's a little inside of that. The moving average, if you kind of take 4 weeks or so and smooth it out, continues to kind of chug upwards. And so, I think some of this is really kind of portending some of the stress we're hearing. I mean, you guys are just talking about the banking system. And if you think about the lending mechanism, that transmission mechanism that creates credit through that system, that kind of hits the small to medium enterprise. And so as you look at that, I think we need to continue to watch that part of the market. We've got to watch the credit conditions as well. And I think that's going to also be a focal point. And so when you look at the Fed, they have some tailwinds to their back on the inflation data. And that's really what we call the base effects, right? Last year's data, in the next couple of prints, if you go last year, what you see is that they were very high month-over-month prints, and there's not the expectation to repeat that. And so you have this nice tailwind over the next couple of months for the Fed. So I don't think at this stage that they need to hike. I think they need to worry more about the stress in the system that you guys were just discussing but before you brought me on. And I think that's going to be the focal point for the time being. So although the market's starting to take up a little bit of a price of a hike, to me it's still far away, and I think the Fed should stay at the pause mentality right now.
Do you think the data is sufficient, though, to eat away at some of the rate cuts priced in the second half?
Well, the rate cuts in the second half are really kind of a strange beast, because if you look at them, it's this orderly kind of cutting system that where they're just going to start to take 25 basis points off the table. And we all know, having experience in markets, that's not how markets work. And really what it's pricing in is a probability of probably a more significant cut. And so, although I don't really expect to see that path of cuts, if there is degradation in the data, I could see the Fed cutting meaningfully. And I think the way that looks is that they pause, they keep rates elevated for the next few months, and then potentially it's late in the game, there's stress in the system, and they need to act more aggressively. And so I think if the Fed is to cut this year, I think it's more sizable than kind of what the market's price, or at least the path. It's more of a step function downward, and it maybe a 75 or 100 basis points will eradicate some of those hikes we've seen this year.
This is something that Neil Dutta of Renmac, Gershon Diston founder AllianceBernstein, also the same thing that you just said, basically, Jeffrey. Either we've priced in too much or not enough. It's kind of one or the other. The Fed's going to have to cut hundreds of basis points or not at all. The front end's repricing a 2-year higher every single day this week. We've talked about that repeatedly through this morning. We're up 7 basis points on a 2-year at 423. Jeffrey, as you know, a lot of people are getting comfortable going out further along the curve, going out to, say, the 10-year, anticipating lower growth and ultimately lower yields. Is that some way you're comfortable with still?
Yeah, and it's something we've been doing really for the last 14 months or so. And so we've been balancing out our portfolios because we still own credit in a fixed income market, but we want to own some of that, what I'll call back-end duration, 10-year and 30-year treasuries, really to offset some of that risk out there. But, I think when you look at the 2-year, even though we're talking about it's creeping up, you're about 422 or so, I think, before I came on the show this morning. And what you see there is that essentially, it says that the bond market doesn't believe the Fed is going to be able to stay at this level, right? If we have a 5.25 rate and the 2 years pricing, let's say 4.25, there's 100 basis point disparity between there. So ultimately, the bond market is saying that the Fed can't stay at these levels for a prolonged period of time. And so these are the highest levels we've seen on the 2 years since we've seen stress in the banking system. And, even we talk about the 10-year, if you look at the chart, since we had the banking crisis, we got in this new range, we're actually at the very upper end of that range on the 10-year. And so we've been really bouncing between 330 and like 362 or so since we had the banking crisis a couple months ago. And so it'll be interesting to see if we can break higher. I think if you get meaningfully higher, it is a chance to actually add more duration to portfolios to not only offset some of this credit risk, but if you think about the other parts of your portfolio, such as equity risk, we think that the 10-year and the 30-year treasury can actually provide a lot of value if there is a degradation in the economy.
Well, let's go to the other side of the risk spectrum for you in the credit market then. Jeffrey, can you tell me how you're managing your credit exposure at the moment, you and the team?
Yeah. So what we've been doing, kind of similar to what I was talking about on the interest rate side, is that we've been migrating up the credit spectrum. So we've taken down exposure on a dollar basis. So meaning the allocation of the portfolio is smaller to things like high yield bonds, things like bank loans. Bank loans to us seem to be one of the riskier parts of the market right now, because that's essentially where Fed policy is directed today, because the coupons have had to reset because of their floating rate nature. So these companies are inherently paying 500 basis points more than they were 1 year ago, or at least 14 months ago. And so ultimately, we think that there could be stress in the system there. You're seeing that specifically in the lower credit quality. So that is something that we are wholesaling trying to avoid today. We still own investment grade credit. We own it, kind of in those middle tiers of the investment grade market. But also, when you look at some of the securitized markets, such as like non-agency RMBS, or even some parts of the commercial real estate market, there is a lot of value. And when I say commercial real estate, people panic and say, well, aren't you aware of all this office and the things that are going on in the space? Yeah. And I say, absolutely. But the thing is that there's a lot of headline risk there, but you can move up in quality in these assets. You can buy things that are like AA rated, AAA rated, that yield 7, 8, 9% today. So if you can underwrite the assets, we think that that's an area that investors should be focused on right now. Now, it's probably a little bit early. You definitely don't want to be delving down into the lower tiers of credit within the commercial real estate market, but I do think that there are some opportunities that investors are overlooking. And so as we're talking about a slowdown in the U.S., the other thing that we have been reducing our exposure to is emerging market debt as well. And so I know there's been a lot of fervor around the sector, because I hear the story that the dollar's peaked, that's the time to buy emerging market debt. And I agree with that if you're in this cycle where you don't have a U.S.-led recession. But if we're really curious about, or we're nervous about seeing a recession in the next 6 to 12 months, emerging market debt just does not compensate you for that risk today. So we're being a little bit more cautious in the portfolio. We haven't really made a lot of changes except buying a little bit more of CMBS in the last month or so. But since the banking crisis, our portfolio allocations haven't moved much because we were pretty well positioned coming into it.
Hey, Jeff, so much to unpack there. I could talk to you all day, but can I just pick out the FX component of that, the dollar call? Do you think there's a risk here then that we move to the other side of the dollar smile, so to speak, that you start to get underperformance almost everywhere, Europe, China, which leads to this dollar strength and that kind of classic risk-off dollar strength move?
Yeah, that's my fear. And this is a debate we've had internally, is that what does the recession look like if we have one in the U.S.? Does the dollar rally or does the dollar sell off? And our portfolio manager on the global side was that, well, if the U.S. defaults, it's obviously a dollar down. But I still think that this would still be a flight to quality, risk-off type of trade, which would probably lead to a dollar rally. But if you do get that, and we're going to recession, we're going to throw a lot of fiscal stimulus at it, we're going to stimulate the economy, I think that's where you really want to be inherently short the dollar or long non-dollar assets. And so right now, we haven't added to those positions. We're watching it. If we saw a little bit of strength in dollar, we want to add a little bit there. But again, I have a little bit of nervousness because, again, just given the way that we've seen with like the Japanese market, right? The Japanese seem to be moving money out of the U.S. and moving over to Europe. So they're not exposed to the U.S. as well. So ultimately, it doesn't feel like people are very long dollars today. Yeah. And so there could be that flight to quality rally. So I share your opinion there.
Jeffrey, enjoyed this. Thank you, sir. Jeffrey Sherman, great to catch up.
Thank
across
you.
A range of assets there. Your FX market, the euro against the dollar, session lows right now. Breaker 108 a little bit earlier, 107.83. About 16 minutes into the session, equities just about negative on the S&P. Coming up, former regional banking heads taking a stand on Capitol Hill.
When contagion hit after the failures of the two other banks, panic sets in.
A conversation up next.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
At the end of the day, when the panic sets in, it's really hard to regain confidence. And so absent some evaluation of the insurance on deposits, which I know the FDIC, I think, is requesting comment or offer proposal, I think that's one thing that would be worth looking at.
We've got a new focus now. Is it the next shoe to drop? US commercial real estate prices falling in the first quarter for the first time in more than a decade. According to Moody's Analytics, the less than 1% decline was led by drops in multifamily residences and office buildings. Moody's chief economist Mark Zandi saying, quote, lots more price declines are coming, a concern the Federal Reserve shares, writing in its semi-annual financial stability report that, quote, the magnitude of a correction in property values could be sizable and therefore lead to credit losses. The Fed Vice Chair for Supervision, Michael Barr, telling lawmakers this week they have increased their oversight.
We are looking carefully at commercial real estate risks. Banks already are in the process of working out commercial real estate loans where they see those risks in appropriate places.
Let's get to the team. Kelly Lyons, Shonali Basak. Kelly, first to you. What are you seeing on the policy front? The regulators' focus, is it shifting back to this?
Well, there's a lot of focus on making sure that regulators act within their existing authority. On the Republican side, on the Democratic side, they would like to see a tightening of regulations. Of course, we're going to have a third day of hearings on the Hill today in which regulators will be in front of the Senate Banking Committee. They were already in the House earlier this week. And of course, we already heard from the former executives of these failed banks. I just got the prepared statement from Chairman Sherrod Brown of the Banking Committee. He says he wants to tighten capital and liquidity and stress tests, consider options to deposit insurance reform, also that they need to improve our merger policy so that failed bank acquisitions by mega banks are only a last resort. It remains a question, though, John, of whether or not any of these measures really can find bipartisan support. Some in the Republican Party I've spoken with over the last few days have suggested that things seem stable enough that there may not need to be any kind of legislative response, just that regulators need to not be asleep at the wheel and act with the authority that they have. Of course, that's not the view of some in the Democratic Party. And I would note that one area of bipartisan support that we may see coming forward in the near future is the idea of executive compensation clawback. Senator Elizabeth Warren has introduced a bill in that regard. She told me earlier this week she'd like to see it marked up in the committee very soon. So we'll see what steps forward we really get, John. But of course, a lot of today is going to be scolding and grandstanding to a large degree.
Once again, Shonali, let's talk about this market, this one focus, commercial real estate in America. You speak to a lot of fund managers, a lot of people with exposure to this. What are they saying?
I think we have to look at a few things. One, I want to double down on this Moody's report a little bit, John, here, because the other part of the quote that Mark Zandi gave was, we're on a razor's edge here. And their estimation for price declines is about 10%. Another important thing that's in this report that is underappreciated in the market, everyone's talking about offices, everybody. Of course they are. And actually, if you look in the big private equity firms, they have data that is granular on just how empty these office buildings are city by city. But in the Moody's report, there's another underappreciated risk here. That is multifamily buildings. This is residential real estate we're talking about. So it's not just office buildings at this point that Moody's is worried about. And again, that is an area of the market that people are talking about a lot less than they are offices, which are more obviously facing potential distress.
Just a huge amount of focus on this at the moment, and that focus is not going away. Shonali, thank you. To Kelly Lyons as well. Just another day of a lot of noise down in Washington, D.C. We can't wait. On the S&P 500, negative by 0.1% in the early part of the session. On the NASDAQ, we're positive by about 0.3%. Up next, we'll get you the trading diary from New York. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
26 minutes into the session, doing okay on the S&P 500, just a little softer, negative by 0.1%. Plenty of action in the bond market, repricing the front end of the yield curve higher. Monday, Tuesday, Wednesday, Thursday morning. This morning higher by 9 basis points on a 2-year, just short of 424 off the back of better economic data and some hawkish Fed speak as well. Will we get more of that? That's the price action. Here's the trading diary. Dallas Fed President Lori Logan speaking again at the top of the hour. We get U.S. existing home sales plus Secretary Yellen discussing the banking system and the debt limit later in the day. On Friday, Biden meeting with G7 leaders, followed by Chairman Powell. Looking to next week, JP Morgan Investor Day on Monday, along with more Fed speak, Bullard, Bostic, and Barkin. Then on Wednesday, we get the Fed minutes. Let's get to the weekend first. From New York City, I'll see you tomorrow morning. That does it for me. This was the Countdown to the Open. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in a hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat.
It brought everything back up, and